Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show.
Good morning, everybody. Happy Wednesday, happy Fed Day. Jerome Powell and company putting their brains together to come out at 2 p.m. to do nothing. FOMC, here's a watch tool. Probably about a 97% chance nothing happens today. It might be baked in a little higher than that. Yep, 99% this morning that nothing changes. So Fed is likely going to keep the pause going. Jerome Powell's press conference is probably going to be more important. The pause for June is also increasing. The probability shows now about a 69% chance that they don't do anything in June. So I'm really interested to see how the statement at we'll say FOMC statement comes out with the 2 p.m. release. Unlikely to change. Once Powell takes the podium and starts to talk live, I do wonder what language he has, and then when it comes to Q&A, if he goes like on script or off script. Usually he is pretty scripted, but I think given the fact that the Fed has made some changes to these recent probabilities, now looking at the potential first cut coming in July, I'm sure they're going to be asking about, trade war uncertainty or tariff uncertainty or the tariff window, blah, blah, blah. So I'm curious if he actually gets into the weeds about, how the current administration's uncertainty with the trade war and tariffs would has made the Fed at least kind of take a step back and assess the uncertainty, or not. I mean, he also could just dodge all of these questions and just kind of meander his way through the press conference, get through it without any real significant information to grasp onto, and maybe it's just a big choppy day. So, I'm looking at order flows for the day. I do expect price to make some type of move. More than likely, we're going to see price have either up or down. It usually is a choppy day. Usually it hits both sides of the trade. Everyone's looking for direction on an FOMC day, and you usually don't get it. So if you're quick to the trigger, then maybe a move to the downside. You're quick to the trigger, maybe a move to the upside. Um, I I would love to take a simple trade like a butterfly spread here. But if you're not able to close that thing out near the end of the day, or price doesn't stay there, I mean, if price goes down early and then up later, or up early and down later, you're not going to see enough. Uh, you're not going to get to the profit trap at the end of the day. Like those profit traps would be best at like literally 3:45 p.m., like right before the close. So I think it's just going to be a noisy day. Looking at the bigger picture, it was interesting these last couple of days. Looking at SPX here. So, we did peak out on Friday the 2nd. We gapped lower, stayed lower, gapped lower, stayed lower. Today's up a little bit. I think that a retest and fail of the high. Let me change the color here. I think a retest and fail of the high would make some sense from a technical side. I think that there's plenty of gap fill potential to the downside to find some support. We have gaps galore. I'm gonna actually box these in. If we go to a smaller time frame, you'll see the gaps I'm talking about. So here's a 4-hour chart. So if we were to, fill this gap, it's right there. If we came down to some structure support, it's right there. We come down to fill this gap, it's right there. We come down to fill this gap, it's right here. So these are all levels that the bears could be clawing after. If the market wants to turn, we could come find these. If we were to come up to the highs, like this to me still has kind of a bull trap written on it. I don't think. I mean, I just read this morning that I think European Union is looking at putting in some countermeasures, and I don't know if it's countermeasures or if it's retaliation. So if this whole idea of global trade is going to go into, we're going to put counter tariffs in against the U.S., and you just add more supply chain friction, then it's probably not good for the markets. Like, more uncertainty is not good for the markets. It may not be enough to take us all the way down to the lows, but we keep seeing Donald Trump be more vocal, and he's still talking. So, I mean, it's Trump. It was a tariffs on Hollywood, and then it was a big announcement that may not be trade related, but big announcements. Like, I don't even know what that means. Um, and what else? Maybe consumers need to be prepared for like the economic uncertainty. I mean, like, the narrative it changes every single day. Okay, so point is, technically speaking, this to me is a potential bull trap area, that I could see the market kind of stabilizing. It's been quiet, but if the market hits resistance, I could see us pulling back into the near term. This may not be a fun ride. If we do have the market dropping, it may not be a fun ride. If the market starts to drop sooner than later, let's say that kind of today is what puts this market lower, right? Another thing that also happens, let's say this week, is Fed pauses. Powell doesn't say much of anything, and then Trump comes out and vocalizes yet again. Fed needs to cut rates. Starts to insult Jerome Powell and say they're behind the eight ball. Blah blah blah. Like that. That can start this whole dramatic thing of, you can't strong arm the Fed. I think that their job is to be independent. What the Fed is noticing is 10-year yields. They're not going down, right? Like, I mean, I was watching this really closely. I put in a lock on a home that I'm closing on at the end of the month, and down here, that lock was around 6.6%, and we shot up around 20 to 30 basis points. So, I mean, if I looked at a fresh mortgage right now, it'd probably be 6.8, 6.85. So unless we miraculously come back down to these lows, and I'll look at another lock if I can within 15 days, but either way, I just don't think these yields are really going to come down as much as everyone thinks. I've said this before. My argument was that I don't think rates come down. I think that house prices come down. I think that everyone's sitting on these crazy high prices, thinking their home is worth 3, 4, 5 times what they paid for it. I don't think that's real when supply catches up. So there's going to be a little bit of a sticker shock on homes that are already existing, and then hopefully builders can catch up on supply and not be building at these outrageous prices. Where I live out here in Utah, basically these manufactured homes, builder grade homes. I mean, they build it like market plus instead of cost plus, which is outrageous, because cost plus should be, maybe a home that should be like $400,000 to $600,000. They're asking, 800 to $1 million in this area. So that can't be what allows people to buy homes in the next, 1 to 5 years. If rates aren't going to get any better, that sticker price is ridiculous. So yield, wages certainly have not caught up with that. Wages are not outpacing that. So I think right now it takes about 45 to 55% of your gross income just to afford an average home price, like a median home price. So anyway, why did I buy a home now? Because rent is the exact same price or higher. So, I mean, it's market to market, but I mean, I was renting for $3,000 a month. To do what? Have nothing to show for it. So I'd rather have the equity in a place that it's a phase one build, that you're building into equity over the next couple of years. Median home prices in the area are about $150,000 to $200,000 more than what I'm building for. So that's why I'm buying a house. So I want some equity, you know? So, I mean, 6.6% interest is not great, but I'm putting enough money down that it's manageable, and I'll be really aggressive. I mean, I'm going to pay probably 1 to 2 extra payments a year to stay ahead of the interest, and it's manageable. I mean, it's about the same as my mortgage was in Michigan. Yeah, I get it, but there's math, and it's called, being more aggressive on paying it down. I mean, I don't have to just do the bare minimum payments. It's like, I get most of it's going to interest. Well, I want to pay that down as quickly as possible. So anyway, long story short is, I just don't think yields are going to be coming down as much as Trump wants them to, as much as he's bragging that they will, that they were bragging back here when they were literally breaking the market, that we're below the four handle. Look at all these great things. There's no inflation. It's like, dude, none of this is going well. The bond market essentially broke, right? So the bond market breaks, the basis trade unravels, liquidity was questioned. Look, I still think the market has the resiliency, and I truly mean this. I think the market is showing better signs of resiliency to get back up towards all-time highs this year. I, for one, as a person that wants to trade that, I don't want to buy the highs. I don't want to buy the highs because I think that's a terrible trade. If we get an obvious breakout above, let's say 5,800, then maybe it's a melt up towards 61. But I would much rather be able to position for, a chunk of participation in here, possibly a revisit of these lows, and have that be a little bit more of an upside trade where we can get to the highs, maybe have some momentum, and again start peeling off some profits. So I mean, this we kind of talked about this last week. If the market went to all-time highs and the only pullback we have is about a 1.8% dip, like this week, this might be the dumbest V bottom that we've ever had. So I hope that's not the case. I really hope that this market takes a little bit more time, offers up, legitimate buying opportunities, buying some dips, maybe scares the market a little bit. But we'll find out. Okay. So keep an eye on that. NASDAQ, kind of similar, floating around these areas. NASDAQ and S&P both have room to fall back. So, I mean, if we pull back into this area, somewhere between about 19.2 and 18.4, that would be, previous low levels in here, maybe a little bit deeper, fill a gap. I mean, I wouldn't mind taking a little actionable bite in here and, back to the low, same thing. But the hard part is if the market is dropping, what type of narrative is dropping, right? Like what type of narrative, commentary, news is helping push markets lower. I mean, I think most of this is telegraphed by the technicals, but you just got to wonder, like, what is in the headlines that's going to help drive this market lower, because it's going to be attached to something. It could be tariffs. It could be, all these partners that are supposed to be lining up, and everyone's saying like, oh, everyone's going to work with the U.S. and they don't. Maybe they don't, right? Maybe European Union is like, look, we're going to do us. We're going to deal with China. We're going to deal with Russia. We're going to deal with our trading partners. We have an alliance with the U.S., but we're putting in, measures to make sure that we are taken care of. And a lot of flows have been repatriated into the Eurozone, defense spending and AI infrastructure and all these other things that are kind of building the future. And the tone is really like it's very nationalistic right now. So I think kind of Trump created that kind of isolationism, and that may or may not put the U.S. in a good position for the rest of the world. It might be this big change where, if you can operate without this heavy reliance on the U.S., then you probably want to put in some protocols to do that. But the whole landscape can change, and that's what this that's what this drama was. Like the whole global trade picture was changing, post Liberation Day. But obviously the market's resilient. It's reflexive. It's come back. We're on the right hand side of the trend line. So being in here and here, I could see the market being sideways. But if the dust settles and the coast is clear, then I do think the U.S. economy is resilient enough. I do think the U.S. markets are resilient enough to get back to these highs. I want to see if there's ways to participate in that. Okay, but a pullback would be ideal. I'd like to see a pullback on NASDAQ towards like 18,700, maybe even 18,400. I'd like to see pullbacks on the S&P, kind of the same thing, around like 5,500, maybe down to like 5,300. So between about 55 and 5,300. I mean, that's wishful thinking. I'm not super excited about buying highs, so I'm probably not going to. If it goes up, okay, fine. If it falls, then I'm more interested in where can I start taking some bites. All right. What else? Dow finally got above the April 9th highs. We had a couple days closing higher. We're still just shy of the 200 moving average on the Dow, which that was interesting. We're still under some pressure on stocks like UNH, and some of the pharma stocks took a hit yesterday with Trump announcing pharma tariffs. Russell 197. Still have calls at 200. If this dips as well, I'll just keep selling calls. Volatility index is still in the 20s. I mean, this is still relatively high volatility. We could stay here. I mean, we can go back down into the low 20s. We can maybe dip into the teens. If things get a little bit more exciting, then the markets go up a little bit between like maybe 20 and 30. So that'd be a little bit more elevated volatility. I hope that we don't come back up in the 50s and 60s. That would be another like round of just absolute chaos if we did. So I'm hoping that things kind of settle down into like maybe, and this is crazy to think like 20s to 30s would be good, right? But that would seem like a relief compared to the scares we had between like the 40 and 60 push. Okay. You thinking stocks are going up? I mean, I think they're resilient enough to go up. I think earnings consensus has been pretty decent. Mag 7 still strong. I think this market can still kind of build on a strong foundation of Mag 7. The one thing I'm watching closely would be this. So above the 50-day moving average and also above the 200-day moving average. This to me is a sign of market breadth, right? So you want to write these two down. S5FI is how many stocks are above the 50-day moving average, and S5TH are how many stocks are above the 200-day moving average. Right now, we only have about 36 point, about let's say 37%. We have 37% of stocks above the 200-day, which means 63% are below. That to me, as a market breadth indicator, still shows that we have a lot of stocks that are still in bear market territory, below the 200-day moving average, right? So about 50% of stocks are above the 50-day, but 63% are below the 200. So we're kind of in that no man's land of like, well, does the price get back above the 200-day, or does price, think about it this way. This was price. Price has been falling, right? If we had a 50-day moving average, so 50-day moving average has been crossed over, right? And the 200-day moving average has been crossed over. So I do wonder if the proverbial death cross. But now if price is bottomed out, it's coming back up here. I'm drawing that like an idiot right now. So we've got to go price is up, price is down, price is probably pulling back. Let me put in some 50 days. So 50-day would be a little bit tighter to price, a little bit more aggressive here, and then maybe price is coming back above it. But meanwhile, a 200 moving average be more like that. That's kind of where we're at, right? So we've got some stocks that are crossing back above, about 50% of stocks crossing back above the 200, but they're still below above the 50-day, but still below the 200. So this is the big question mark spot: is will price hit this 200 and reject? If prices hit the 200s and reject, then we're still in a bear market move. Like this would be that bull rally in the context of a bear market, and we could see another at least flush down. May not be breaking the April lows, but another flush down pushing lower, right? So I think right now this is not really a time. I'm not buying really anything. I'm generating income. I'm selling covered calls. This week, for example, let me go to Tesla. I mean, I've got covered calls on Tesla. I even debated just throwing in, some shares on SPY or Qs and just selling covered calls, and just if it goes up, make some money, do it again, do it again. But just trying to take some bites and nibbles at. I think right now the best thing to be doing is like if you have shares, sell covered calls. If you're looking at opportunities, I'm trying to get in and out within probably 1 to 4 weeks of just selling premium, selling covered calls, doing my income trades that I typically do on indexes. But I'm not committed to really any major direction. Okay. So let's go. We did Russell. VIX is in the 20 still. The bond volatility, it's come down off these highs, which is a good thing. Take a look at your IEF. Actually, we'll go shy. That's the 1 to 3 year. So the bond market dropped hard. There's 1 to 3 year. Here is 7 to 10 year. Here's TLT. So we're moving off the lows. It's helping yields a little bit. Here's your 2-year yield. Here's your 10-year yield. Here's your 20-year yield. But there was enough bouncing. I mean, Liberation Day, Liberation Day, this was what kind of broke the bond market. It wasn't a who was the is it wasn't the prime minister in the UK. Was it Truss in the UK when the bond market broke in 2022? The UK gilts broke in 2022. Bank of England stepped in and backstopped it essentially. We didn't necessarily have that right away, but we did have a major component of liquidity in the bond market basically get busted up and broken. And we still have not gotten back to Liberation Day levels, right? So unless this is going to be a surprising improvement to the downside, I think that yields stay higher. And this is probably the biggest corner that the Fed has been backed in a long time. It's like they don't really want to cut rates. If rates are cut, but yields respond the opposite way, none of this is good. I keep saying this. and this is my biggest concern about growth moving forward in the US, is that we are basically going to increase rates, which means increase borrowing on everything. You want to buy a car, it's going to be 10+% now. You want to buy a home, you're going to have 8 to 9% interest rates. None of that is good. If we're up here to like 4.95% on the 10-year, you're talking about 8, 9% mortgages, on houses that still haven't come down in price. So this could all be, a year plus away, a couple years away. But if we just have like this chop fest and yields don't go down, I'm actually very concerned with what the Fed does this year. If they cut rates and the markets don't respond with yields coming lower, if yields don't come lower as the Fed cuts, and we do this again, this just gets harder and harder to kind of work through. I think an optimistic picture, in my opinion. Okay. So anyway, let's go back to some other charts here. Let's go SPXY. If we have a dip in the market, I'll probably play that dollar index. I don't know how many people are aggressive in the dollar right now. I'm not. I'm still waiting on the dollar to couple things. I'm not short the dollar because we had, look, the opportunity to be short was up here. And maybe on this bear flag, that would have been the opportunity to be short to come into this low. Like that was the best trade. And I know it's like there's times like this where you see a chart and you wonder like, oh, that was an easy trade. No, it wasn't. The dollar was completely bullish. Like this was the easiest trade in the dollar. You bought the dollar and you looked at going after these highs. That was a great trade on the dollar, and then you start trimming some profit. You hit these tops, you start to sell the dollar, you take it back into structure. Like that was a realistic trade there. And then you had a bear flag. That was a realistic trade there. So in this whole environment from straight up to straight down, you could have grabbed, one good trade there, one good trade there, one good trade there, and now we're waiting. Like this is to me not a good trade. Where we are at is, I don't know, right? I mean, I think that the dollar is still due for a correction. I think that having oversold conditions, dropping as quickly as it did, that the dollar remains like relatively choppy down here. If it just goes sideways, I mean, I think sideways back to like a 101 or 102 pullback is still a sell worthy dollar. But if we go kind of sideways with a little bit lower lows, sideways a little bit lower lows, then that's more of a falling wedge that's probably going to have a squeeze coming later. So I just don't have a trade that I like on dollar pairs. I mean, euro dollar is about the only one that I like. Come here, dude. Come on. Euro dollar looks okay to me. But you got to be willing to trade small and kind of hold your levels. It's going to be probably pretty volatile, maybe a little bit uneventful. But I think the bigger move would be that the dollar does have a correction coming first, and we get a pullback on the euro dollar. But just be prepared that if the euro dollar goes higher, dollar index goes lower, this low is probably still divergent and probably catches a bottom and still squeezes back. So if you can hang in there for euro dollar, I think the Fibonacci levels and the pockets and the pivots that are missed along the way from that 105, 105, 106 to 113, 114 run could still be pretty good. Okay, so that's dollar index. Oil. I did close out my trade on oil. I took a $10 loss. I mean, the announcement yesterday, it's like it just seems like pressure is on to have more supply side. So I mean, if production increases, it could drive prices lower. I thought it would take a stab if the market was going to hold this level, and it may still hold the level. But if we just drift lower on increased production, I don't want to sit here and say I'm going to be bullish on this, right? I mean, I'm calling the bottom, so I bailed on CL. That's my crude light futures trade. I got out of it for a $10 loss. At this point, I mean, again, kind of the same thing as like, does oil come back up to this level to reject? Does oil leak a little bit lower? If so, it's probably going to do it without me. I'm not that interested in, there's like open space to the downside, but yet I'm not that bearish. And at the same time, it's like, could we get back to 65 and then make a squeeze above it? Sure. So I think it's a tough trade. It's a tough trade. Be careful on the risk side of oil. There's so much like supply and demand manipulation that I just think it's a tough trade. So I'm not really doing anything on oil right now outside of just kind of observing. I am long on natural gas, however. I'm still holding this one out to 2027. So, this did come off these really nice lows. We got into a buy zone for a while. My issue on this one is that we are now like kind of on the cusp of, are we going to stay in this sell zone? Or are we going to get back and return into the buy zone? I'm hoping that we return to the buy zone because I'd like to see this thing going higher, and I want to still add some diagonal parts to it. So speaking of that, we're at 18.11. I have a break even around 16. I probably need to, I think I'm going to sell another one. I'm going to write this down. I'm going to sell another call and just continue to lower the size of my debit. This is a long diagonal spread. So this 417 is expired, but I'm still sitting at a $5 long call with a, roughly 16.25 break even. So if I can sell a, 18 or 19, I don't want to get it called away per se, but I want to see, I should be in some profit on URA. So you are I'm sorry, UNG. Yeah, UNG is up about $630, but I want to add another leg to this. So let me see. We're at $18 right now. Actually add this trade in. So UNG trade. If I go out, I go to $19. There's some income here. I think I'm just going to play it pretty close. All right, dude. Yep. All right. So I don't want to go out too far. This is only out to next Friday. Let me look at if I get a 19 called away, be 11.25. 11.25 minus 42 cents. Get it called away at $14. Yeah, I still make about $300 on the trade. And I can also roll this. So I think I'll add these in. I'm gonna look at the 5.16 and just try to be a little bit more aggressive on that sell side for that diagonal spread. So that's natural gas. Gold, 33.82. I said this. We saw the 2-day jump, right? The 2-day jump here, but I think we're still kind of capped at these recent highs. So just be prepared for some consolidation. If you're scalping, well, obviously that was a good opportunity to scalp. I just wouldn't be holding for crazy high gains. I think that this, after another run, is probably going to pause a lot like it did here, a lot like it did here. I could see the same type of thing where we just kind of pause and go sideways. Does this catch a bid and go higher? Sure, maybe. I'm still waiting for a better correction into the deeper exponential moving averages. This is a 100, a 144, and a 200. So anything sideways allows these moving averages to catch up, and then any type of dip into them, I think that's dynamic enough to start buying. So maybe this is wishful thinking. It's like coming down to 2,800, but I keep repeating this, but it's I'm not going to be taking the bait of buying highs. I've already had a 3-year run on gold. I'm enjoying that run, but I'm not going to buy these highs. I want to see gold consolidate, and then there's a good technical reason to be long gold. But if it just keeps there's a little tiny dip after a week, and then it's up to fresh highs and a little tiny pause, and then just let this thing go into a bubble, and I'll take profit at, who knows, 4,000 an ounce, 4,500 an ounce. But if the ratio, the typical correlation is if we see equities go up, okay, gold is usually going down. In this environment, that's kind of what's playing out. If equities go up, gold is going down. If equity goes down, gold's going up. So I think that this was initially seen as a safe haven play, and this rally here was pretty much the big drop that we had in March and April. So as the stock market was dropping, gold was up. Now that the stock market has bottomed and we've recovered about 17, 18%, gold is sideways, right? So I think that right now, that's correlation you need to watch is if equities are going to continue to find ways to go higher, I think gold is going to take a little bit of a breather. So that's why I'm just going to be patient. I'm going to wait for at least dips. I'm going to wait for sideways consolidation. I still think gold is a good bid. I think there's central banks and global requirements. People want it. Central banks want it. Countries want it. But doesn't mean I'm just going to chase the highs. Silver. I do like silver a lot. There's 2 levels, 29 and 26. If we come back anywhere near these lows, and this could be a little consolidation, we could have a trend line break and this could go higher. But if we come back to 29 or 26, I will start establishing more, probably 12-month positions on silver to stay long. I like silver a lot. What do we have here? Fall right, make a new high later. Pattern of May. I mean, yeah, possibly. You're talking about a seasonal pattern, as in like stocks go higher. And yes, I'm mostly on the daily time frame. And look, dollar versus gold. It's like it's possible that a little bit of a squeeze rally in gold would push. I'm sorry, a bit of a squeeze rally in the dollar. So if the dollar gets up to 101, 102, then yes, I think gold would fall a little bit. Um, but I don't know if it's just I don't know how tight the correlation is with gold versus dollar as opposed to equities versus gold. I think right now, if equities go lower, then gold could possibly stay bid and maybe go higher. But between those three, it's like watch the dollar, watch gold, watch equities, and you're going to see like the kind of seesaw effect of like one goes down, one goes up. You'll see the inverse correlations. Okay, but I think right now, the stock market, unless we have like some very disruptive news coming out, I think the stock market is offering up some really good structure to buy dips. So a dip, like I said here, 5,500 to 5,300 to me is a pretty attractive spot to at least start to take some bites on the SPX again. And if we, and the target would be all-time highs. I mean, if we're pulling back to this area, if I'm taking bites in here, that's a discount, and I'm looking to get to all-time highs. If I take some bites in here, I'm looking to get back into all-time highs. Now, if we obviously revisit April lows, then this is a potential range that we have a high, we have a low, we have a high, we have a low. Like we could also do this. This market has done this in the past. 2015, 2016, a 2-year range before it broke out. 2018, 19, we essentially went sideways for 3 years. Like we could be in that environment where it's just a lot of ups and downs, and maybe what feels like a lot of volatility, but it's really just like a 20% high to low, and the market's going to bounce back and forth between those levels. Okay. All right. So gold, silver, Bitcoin, another nice like 1-day pop. We're back up towards 97,000. Little consolidation's fine. If Bitcoin wants to melt up a little bit higher, I'm not opposed. I'm not unhappy by this thing going back up to retest all-time highs. I do wonder if this is another accumulation phase where it goes up to hit all-time highs, and then comes back down to offer up either a halfway point to buy or offer up a range trade to buy, and then we have a chance to trade the lows, maybe take some profit or try to hold for a breakout. So I'm still holding. A lot of Bitcoin. I still have IBIT as my kind of stocks and options way of exposing the equity portfolio that I have. So it's still doing pretty well. Overall, overall still up about 40, almost 45 grand in Bitcoin. So we get to all-time highs, that's probably up towards like 60, 65 grand. We get to fresh all-time highs at, Bitcoin spot price is 120, 130, 140. Then we're going to be up like $70,000, $80,000. I'm probably going to start trimming that back and take some profit. All right, let me check some DTE trades here. So Bill, Upstart, App, Hood. These are all earnings plays that I'm watching. Shopify. All right, come back to that in a sec. All right, that's Bitcoin. MicroStrategy 392. I have a bull call spread on MicroStrategy that is now up $265. Max profit on this one is about 1150. So there's still plenty of time, and there's plenty of time in the trade. What I'm looking for is if we start to see MicroStrategy up over, let's say 425, 450, then I could probably close this thing out for maybe a $500 or $600 profit, which I'm okay with. Like if I can turn a 332 debit into a 100, 150% gain, max profit's like 300%, give or take. But I'd still be happy making $500 or $600 on this trade, and not having to wait all the way to January just to eliminate some of that volatility. I also still have covered calls out to, it's a collar trade out to June, but if we stay above 310, this is another one that I might continue to sell some covered calls and roll. If we're just going higher in MicroStrategy, I'll just keep rolling calls. But the reason I stuck it out to June was because if we have this like big pause window in tariffs, I turn a little bit more bullish into this window, thinking that the market's going to be relatively calm, not a lot of drama until maybe July onwards. So hopefully, to be smart, I could just let it get called away, and I'll still make about $17,000 on MicroStrategy. in addition to watching where these bull call spreads trade. So overall, MicroStrategy is doing pretty well. What else? Coinbase, looked at this one yesterday. I'm going to wait and see what happens if we get a dip. If we dip back down to these lows, I'll probably look at some ratio, or yeah, price and ratio spreads and income trades. Ethereum, I'm sure that traders are wondering and waiting, but if we get on the right-hand side of the trend line here, Ethereum could be a pretty attractive buy and a catch-up opportunity to get back to these recent highs. But I still like Bitcoin better. Really, I still like Bitcoin better. Copper still chop fest. Japanese yen, recent highs. Maybe just a big range is still playing out in the Japanese yen. I'm still long Japanese yen, not in currencies, but in FXY. EWJ, the way I'm trading the Nikkei is I'm still in profit here with a couple of dollar cost average levels. The DAX just shy of the all-time highs. So, I do wonder if this is just a big range trade, like a big shakeout trade, and maybe we're up and we come back down to the middle. Maybe this is going to be, in the stock market would be the one market that I would say that if we get to, this high, and we actually pull back, having some type of structure in here still offers a chance to buy the dip and then see new highs. If I was in a currency market, I would never do that if we're sitting at all-time highs because we're likely to have, reversions and pivots and balances. But in the stock market, when it's like these are designed and built to go higher over time, this could still be a bullish pattern. So if the DAX can pull back in here, I think it would offer up the opportunity where you missed the V bottom, right? If you didn't trade the V bottom, if you weren't that aggressive, then perhaps it offers up a chance to buy some more, and then we get another surge to fresh highs. Okay, FTSE, kind of the same idea. If we come up to these all-time highs, come up to the all-time highs, maybe pulling back in this zone, accumulating some type of consolidation, and then maybe breaking new highs as well. I kind of like the Eurozone a little bit better than the UK right now. Argentina, I'm staying out of that one. China, big rejection candle yesterday. Brazil is just above. Actually, it's now falling back below the 200 moving average. ILF is sideways. That's Latin America. Mags 46. We're dipping a little bit lower. Let's take a look at the heat map this morning. So we have about 61% of stocks advancing. Amazon's leading the way. Amazon's up about 2.8%. Man, it's expected to move by Friday. It's like, come on, Amazon, do something good or bad. I mean, at this point, right in the middle, this is worst case scenario. So if we drop, okay, fine. If we rally, okay, fine. If we stay in the middle, then that sucks. For an earnings trade, it's fine. Like longer term, I'm just long Amazon. I don't care, but ratio spread looking good. Long term, I think this stock gets back into the the 200s again. But anyway, Mags. Let's look at Apple. Apple is down. That was an earnings trade. That was profitable. Yeah, I think there's some noise here. I mean, if I would say this, if Apple came back down, I mean, under $200 is a pretty attractive spot for Apple. I might be looking at a another ratio spread here if the premium is decent enough. This would be a pretty important bull spot. Like we don't want to see the bears do too much damage below these lows. So let me see. I mean, their buyback game has been pretty darn strong. 169. Let me see if I can get something on Apple that looks good. Apple. Let's go out to July. If I did a ratio spread like a 160, 155. So $1.10 income, would I be willing to own some shares of Apple at 155 or lower? I mean, that break even, if I did take shares, it'd be a 155 assignment minus 5 minus $1.10. I'd own shares at 148.90. 148.90 would put me about a 42.8% discount on Apple. Not a bad, I mean, it's not bad. I don't know if I get super excited about, owning Apple. It's a bit less volatility. Premiums are okay. If I did a 30-day covered call, for example, what's at the money to repair it. And you get anywhere between $6 to $9 for an at the money covered call. I mean, I think I could flip it for income. That's really not the issue. So that's not a bad trade. It's only out 72 days. Okay. So let me think about that. $1.10, 137. I mean, to me, it's worth it to keep over $100 of income. I would be willing to own the shares. We already had earnings on Apple. Let me see. Yeah, I don't think this is too bad. All right, I'm going to take this trade. So see if I get for maybe $1.10 or better. Let me try. I'm going to try to get a little bit generous on the fill and go for $1.15, but I think 110 would fill. So let me take this trade here. This is a 160 by 155 ratio spread, and this trade is out to July 18th. So let's go here. 115 not filling. Try 113. Try the mid price at 111, 112. 110. 109. All right, just got filled at 110. Got filled at 111. Let's go to this account. Okay, so trade is in. I'm going to add this one to the mix. So this is Apple. I'm doing this in margin accounts. I'd be willing to own the shares. 7/18 expiration. Buy the 160 put with one contract and sell the 155 put with two contracts. $1.10 credit. And I'm willing to own the shares. That assignment price would be 155 minus 5 minus 1.10, so 148.90. Okay, so probability of profit on that trade, about a 96% chance of profit. Chance of assignment is about 7 or 8%. So it's a pretty low chance of assignment. If you don't have the cash to own the shares, I mean, I'm still collecting about $3 total, or we'll just look at the debit of well, the credit of $1.56. If that $1.56 credit is trading for like $3 or $4.50, rather than taking the assignment, you could just close out that essentially cash secured put, just close it out for a loss. So if you treat it like a ratio spread with a naked put where you don't want the shares, then you can close this out at like a 200% loss. So that way you can avoid the assignment, lose a couple $100. But if you win, we got a good chance of profit here. That low in April, I think, is pretty significant. Okay. All right. So I'll add that into Pulver Alerts. And this one's done. So I'm just going to modify this. So this is a 7/18 expiration. Buy the 160 put. Sell the 155 put. $1.10 credit. Okay. There's the trade. So let's go 160 in here. Anything to the upside makes money. There is obviously a little risk on the trade, but that's pretty much what this trade looks like. So the risk would be if price is below about 148, then there's risk in the trade. If we stay above 148, this is a break even or better. So plenty of upside potential on that trade. All right, that's some Apple, Amazon, Broadcom, Google. Google took a big hit today. Wow, that's way down. What's going on with Google? New malware linked to Russia-backed hacking group. Cool. Well, what do you know? What do I have running on Google? I don't think I have any trades running at the moment. I think I closed out most of those. Yep. So I have January and December ratio spreads, which right now are dealing with a little bit of change and volatility. But there's a ratio spread that I'm thinking, look, I'll take Google. I'll own it at one. Try to think, get assigned at 130 if assigned, get assigned at 130, take $5 off that, take another 280 off that. I mean, I'd have like a low 120s. So 130 minus 5 minus 2.80. I don't shares at 122. I don't shares at Google at 122. Highs at 207. If I could own this thing at 122, yeah, I'll sign up for that. 122, all of a sudden we have a 69% upside to get back to all-time highs. I'd take some Google. And if not, I don't have to hold it to all-time highs. Obviously, I can just sell covered calls and repair the stock and make a few $100. Does not have to be difficult. So anyway, that's Google. Meta. I still want to see Meta, maybe a range trade. If it's possible, I'd like to see some of this. If we come back down to these lows again, I'll probably put income trades in. I might dollar cost average as well. I mean, if Meta runs away from me, that's fine. I'm not buying a $600 stock. It's either dollar cost averaging into it, but if I want to trade options on it, I want to be basically doing like income-based options versus tying up 100 shares on a $600 stock. Microsoft own the stock. I mean, dollar cost allocation was started in here, bought again at 370. That's gone up to the upside, did some earnings plays. All these 1-1-1 trades that I did and ratio spreads all worked out pretty nicely. So anyway, just kind of sitting on some stock right now. Netflix, still carving out some fresh highs. Just going to let it do its thing. NVIDIA, it's okay. I mean, NVIDIA's definitely quieted down. I will say on NVIDIA, I do have I have a collar trade. So NVIDIA, I took off a bunch of my naked puts, and all I have is I've got shares. There's my collar trade, and I have a naked put at 70 that's up about 35%. So I'm going to label this one. This is going to be a collar. So the 80 by 130 for July. So I mean, if it doesn't get called away between 130, if the put doesn't really offer me any protection to the downside, then I'm likely going to be more aggressive on just selling like weekly covered calls. And my break even on NVIDIA is, check here, NVIDIA. Got to find it in my tracker. There it is. So my break even is 119. So if I go into July and it's not getting called away at 130, then I'm just going to sell, 120 cover calls, 120 cover calls, 120 cover calls, 119 cover calls. Like I'll just be aggressive and chip away at it. I'm going to try to get that cost down as low as I can. Okay, Tesla 273. I'm going to try to get through the Fed today. I will wait for the Fed because if I roll it out to next week at a 257.50, if I just roll it and assume that we're just going to stay here, I want to wait for the Fed because if this all of a sudden pushes lower, then I don't necessarily have to sell the 257.50. I can sell a 255. I can sell a 252. I will keep an eye on this one. I still think Tesla is I think right now it's in an environment where it's a great trade to be selling covered calls on because you can lower the cost basis. I'm doing this essentially every week. If I were to roll it right now, look at Tesla. So here's my covered call. If I rolled it right now, if I rolled out a week, I get, another 350, 370 bucks at this trade. The reason I'm going to wait is because if price is going to drop, and increase volatility, then these premiums might go up a little bit. I'd still like to roll it out by the other week, and if I have to, turn this down, I still have some flexibility in increasing my credit, but also, adjusting my break even, which right now my break even on Tesla is like low 240s. So new break even. Yeah, let me check on this account here. So this is a 280 covered call, up about 56%. So I mean, this is a good example. I bought shares this week. This is all in the pulver alerts. So I bought shares this week. I took in $8.10. If we're not going to stay above 280 this week, then I'm just gonna roll it. I'm either gonna roll it or I'm gonna roll it down and just continue to collect some income on this trade. So it shouldn't be terribly difficult over like week to week to week to sell some premium and still hopefully flip this stock for a couple $1,000s. So I'm gonna watch. If I wanted to take I mean, look, if we go up to 280 this week, then I get it called away, and I'll make $650 on it. But if I roll it out a week, it actually might not be a terrible idea to roll. Let me see. I roll this. If I roll it out a week, I pull in about $5 if I keep the same strike price, about $6 if I take it down $2.50. Let's do the numbers here. So if I have a 273.53 break even, take away another 590, get it called away at 277.50. I mean, I make $987 by next week. Like, that's not a bad trade. If I go down another strike for next week, do the math again. I'm going to make less money, but I'm just thinking like I want to lower my cost basis as quickly as possible. Minus $7, 266, get it called away at 275. Yeah, I mean, I'm on pace to still make like $800 or $900 on the trade if I play around with a couple different strike prices. So the question is, if I roll it, do I want to roll it? I mean, there is a way that maybe price goes up this week and it could get called away, which I don't want it to. I want to actually roll this out a couple of weeks if I can, generate some income. So Tesla's on the list of some cover calls to attend to this week. All right, what else? Berkshire Hathaway. I don't really want to sell Berkshire. I wouldn't mind scooping up some lows here if we revisit them. I know the market was moving a little bit on earnings. Buffett is stepping down as CEO, but he's going to stay in as chairman. So I don't know if that really adjusts the price at all. They're still sitting on like $347 billion of cash, like sitting on the sidelines. I did find this. I read this on the Buffett indicator. So here's your Buffett evaluation model. It's U.S. stock market value over GDP, and right now, it's 211%, which shows that it's overvalued. So strongly overvalued stock market, which timing wise, we're now two standard deviations above the historical trend line on this Buffett indicator. So this is stock market value versus GDP. So part of the reason that Buffett and Co. at Berkshire were going into cash and becoming net sellers of stocks was because from his metrics is overvalued, right? So there's stock market value, there's GDP, and we're way overstretched. So I thought this was just an interesting way to look at it. This is probably why they're sitting on cash, and I don't know what level it is that he comes back in, right? Does the market have to come back down? Come back down to April lows again? Do we have to have like a freaking crash for this to be like, well, now it's undervalued, right? Are we back to the historical trend? Are we undervalued? And if so, then I'm sure that $347 billion of cash that's making about 4% interest will be deployed again. Into what? I don't know. Probably the SPY. Like, it's not rocket science. It's just, I mean, it's funny how Buffett says don't time the market, but here he was a net seller of stocks. Well, I can almost guarantee you that if we're at this trend line or lower, he's going to be deploying. That's timing the market. I mean, this would be buying stocks. This would be buying stocks. So anyway, we'll see. Bonds we did. Let's get some currencies and I'll wrap it up here in just a couple minutes. So for the day, I'll make sure I'm good on the calendar time. Yep, I'm good. So for the day, currency strength, Swiss on top a little bit, Japanese yen weaker, Aussie New Zealand weaker. We have some risk off flows. S&P is down now for the morning. Everything else is hanging out around like 10-20. So pretty choppy in the currency land. Price has fallen a little bit out of the morning range. We're now down, flat really. NASDAQ down about 0.36. Dow is up 0.33. Russell is up 0.16. But S&P flat, NASDAQ down slightly. NASDAQ probably mostly attributed to like a little bit of a pop in Google. Google going down is going to drag NASDAQ a little bit heavier. And then currencies, Aussie CAD. This is good. I want to see a pullback here. So a low, high. Let me just use a fib. It's a pretty easy way to look at it. Go low to high. And this isn't perfect, but I mean, I guess you could just take the fib and swing it up to this high. So if we pull back 38 to 50 to 61%, I think this is a good box to be looking to look at a higher low, look at a swing trade, takes a profit at that high. So I would be willing to buy there and also back at the lows and see if I can get back to these highs. So that's Aussie CAD. Aussie Swiss, turning a little bit south. This is why I didn't just jump in and buy a bunch of crap. Because if this pulls back, are we looking for a higher low and then a higher high, then a higher low, higher high? Like maybe that's all I get. And I turn this into profit right there. If it comes, all the way back down again to the lows, then I'm looking at this as a bottom. Does that rally back up, take out the high? I mean, so anything back into here, if Aussie Swiss comes back into like 56 or 5,700, I'm taking some profit. Japanese yen. I mean, with this low from April, if we have a pullback on Japanese yen, be patient, but man, look for a nice clean trendline break. This might be a good opportunity to look at the Aussie yen for a buy trade. I don't think you have to force a trade. I don't think you have to guess where the top or bottom is, but if that trend line breaks, I think there's a little bit more permission to be confirming something long. And that does give price the chance to be messy and sloppy and maybe pull back a little bit. But if we get on the right-hand side of that trend line, I think we can go long. Aussie New Zealand, I'm still going to dollar cost average and stay long. Aussie dollar, we're getting a pullback. I'd said this. I mean, this is why I was not long Aussie dollar. I was long here. I was long here. But I want to see if this can pull back into, maybe this area. Pull back to this area, then start looking for Aussie dollar longs. CAD Swiss, still waiting for a bottom. CAD yen. I think as long as this low is not aggressively breached, then there's an opportunity. If you're going to be really patient on CAD yen, look for a break above this, measure your move, and that could be a nice winning trade. But if it's messy here, you might have a chance to buy the lows. Just confirm it on a lower time frame. Swiss yen, no trade. Euro Aussie. I mean, if this is where we bounce, if we bounce all the way back up here, I'm probably not going to take that trade. I'm out of this trade right now. I'm just gonna wait. I'll observe. Euro CAD, I still like the sell trade. If you're selling small, I'm willing to sell at the high. So area 1, area 2, and I'm targeting 5,400 lower. Keep an eye on that one because if oil takes a big drop below the $56 low, I wouldn't want to be holding this one too much higher than I'd say like 6,000 is a nice round number. I would be willing to kind of bail out of this trade as long as we are, holding below 6,000. I think I'm going to be willing to hang on to this trade short. Euro Swiss, just strong support around 92, but no guarantee that bottom is in. But I'm looking to see if it will hold. If the low holds, good. I want to just get this thing back up to 96, 96.50 and take some profit. Euro pound, nothing. Euro yen, nothing. Euro New Zealand, kind of the same thing. We bottomed out a little bit. Maybe a pullback into, this area, but that's about it. Euro dollar, I still like the structure on euro dollar. If you're willing to sell it, area 1. If you're willing to sell the highs, area 2. Even if it's a range trade, I mean, if I sold it now and I sold the top and it goes back down, I can turn this into a small profit. I turn this trade into a nice profit. that is enough to start eliminating risk and see if we get to the 30, 38, 50% pullback zones. So that's all I'm looking for on euro dollar. Pound Aussie. I mean, short term, if you go to a smaller time frame, this one might be turning. This could probably pop right back up into this 2.1 handle. So if you're looking for a scalp opportunity, I kind of like that trade for a low risk, high reward. But you got to be pretty precise on the smaller time frames. Pound CAD, still pretty choppy. If we, hold this resistance area, that's a good spot to look for sells and just trade the range. Pound Swiss, I still like Pound Swiss. I will probably take a trade on this one if we come back into this halfway point or this low. I'll buy small, and I'm looking for this pocket to get filled. So I'll keep an eye on Pound Swiss, but I think if I'm dollar cost averaging into some lows, this thing will, give me the move into the pockets that I want. Pound yen, no trade. Pound New Zealand, equal lows, maybe a range trade off the lows. Get some precision on a smaller time frame. Come to the lows. You guys kicking me off, Chandler?
Hey, Chris. Yeah, we have the next segment beginning soon, but
Cool.
I wanted to thank you for those of you guys who might not know. I don't know if we put it anywhere, but Chris sent us a little care package to the office, and one of which was a collection of hot sauces. And we've all been trying the various sauces in that collection. One of which is pretty hot.
Did you get some Pepper X in you, Chandler?
I got some Pepper X.
Yeah, man.
And saying it's spicy is a bit of an understatement.
Yeah, it comes with some burn.
That'll light you up.
That's right. I'm glad. That video that James did yesterday was great. So I appreciate the video and the content.
Yeah,
you guys are more than welcome.
James put a video. He put a video in the Discord. So if you're not in the Discord, you're missing out. James put a fun little video. He sampled each one of the sauces on camera, which was funny.
He did like a true pro. That was a true Hot Ones pro right there. That was good stuff.
He went through the whole thing. He's a veteran now. We've yet to have Nick try any of like the super extreme sauces. So we got to get him. Nick. We got to get him to do that. I think maybe tomorrow we might shove a camera in his face and see if we can get
put him on. Look, I think James said it in the video yesterday. He's like, Nick said he tap out around 6, and I'm like, dude, just go up to 10. Just get up there. Let's do it.
Yeah, I put a drop in a spoon.
Fine in 5 minutes.
I put a drop in a spoon, and that was enough to light me up for a good 30 minutes. That was,
there you go.
A lot. But Chris, thanks for coming on, and we'll see you next time.
Sounds good. See you tomorrow.
All right, see you.
All right, bye.
We often get asked by our US viewers, how do you guys trade gold and indices on a regulated broker? To trade gold, indices, and more, we trade using Weebull. And for US citizens watching now, for a limited time, you can get free stocks if you use our promo link that can be found in the description or dropped in the live chat right now. Weebull is our top pick and personal choice when selecting a broker here in the United States for stocks, indices, and commodity trading specifically. Get your free stocks now by clicking the link and signing up using the instructions found there. Now,
hey guys, how's everyone doing? I hope you're all well. Today's the big day. Rate decision coming. FOMC, all the fun stuff. Has anyone got positions as we run in? Let me just pull up a calendar here. So 7, yeah. Not too far away, a couple of hours. Ball out, hello, Lee. Okay, so there's nothing on my watch list really. We've still got, I'm still looking at the NASDAQ for a potential long position. I'm not going to be doing anything before FOMC. I don't think it'll be very interesting, to be perfectly honest. I think we are just going to get, very typical hold and then data-based or data dependent, whatever, and then I think it'll be very, very flat. But I don't want to be unnecessarily exposed to something that is a shock, so I'm quite happy to just stay pretty much flat as we go into FOMC. Ball out, still in golden oil longs. Nice. I'm still in my oil long. I'm not sure how that's doing, actually. I'm not sure. Still oil long, but that's pretty much it. In Swiss yen as well, of course. So you're in euro dollar short. Very nice. Long on pound yen since last Friday. Let's have a look at pound yen. So what price did you say? From 1916. 1916 is pretty much here. So you're just around entry, really, aren't you? Long New Zealand dollar, interesting. Oh, sorry, short New Zealand dollar. My bad. Did I say short or long? I'm not sure. It's been a long week. I don't know. It depends on your view. I mean, I am very mixed on the dollar. Now, I saw a guy that I think Nick might be friends with. I'm not 100% sure, but I know him. He's called Dan Emerson, I think is his name, how you say it. Anyway, to get to the point, he put a video up mentioning pretty much the support on the COT data for the US dollar. Now, if we look at positioning, actually, it doesn't display on here, so all right, ignore that. Either way, the sort of 50% level on COT acts almost like a support for the long percentage. You can see here this yellow line, and I didn't even notice it, but I thought it was quite a cool thing to point out. So I'm going to show it to you guys, but credit goes to him because I didn't notice it. But every time, at least back since 2023, every time we come around this 50% level, we might dip below, as you can see we did here, but it does pop back up. I know leveraged funds for 6 weeks straight have been adding on long positions onto the US dollar as well. So smart money does seem relatively bullish for the dollar. Whether that's going to fluctuate or, if that's going to lead into sort of a trend change, I'm not confident in that. I'm not sure. Tonight's FOMC will be interesting. It'll give us a bit more of a direction on what Powell wants to do. So we'll see. But as for your idea, if you're bullish on the dollar, I get it. I'm not necessarily super bearish right now. I do think the dollar needs to have some upside. Or when I say need, I'm going to say due some upside. I think that's a better way of saying that. We've had a multi-week sell-off here. We've had very, very little upside. So I do think it would be expected for the dollar to come back up slightly before maybe heading lower. However, you can see I've got the drawing on the US dollar here on the chart. We do have this really nice weekly trend line. And again, if we pair this with the COT data, this might be quite a nice long opportunity to get long on the dollar back into possibly previous highs. And that would also be backed up if the Fed is neutral, slightly hawkish. I don't think he's going to be, or Powell, I don't think he's going to be very hawkish. I'd expect him to more be around the neutral. I don't think we'll really get that much from him as normal. Lee, hello. Have I eaten Bashi? I'm going to assume you mean because he's not here and not that I'm fat, but no, I haven't eaten Bashi. Yet, anyway. Might change soon. What's your thoughts on dollar Swiss? I would quite like to go long dollar Swiss because I think the Swiss is overvalued. Oh, well, sorry, that's the wrong word. Not overvalued. I think the Swiss is at a precarious point, shall we say. I don't think it's going to have that much upside. And if it does, that then puts it at risk of an intervention by the S&B. So I'm not going to sit here and say, I want to go long on the Swiss because I would be very cautious going long. So that puts me automatically more towards a short position. And again, I'm sitting a little bit bullish. I've been relatively bearish on the dollar recently. And now I'm starting to maybe flip that idea on its head. Not long term. I still think we're going to see the dollar hover around 100 to 90 by the end of the year. We'll see. I mean, that's a big range, but we'll see. But short term, as I said, I do think the dollar is due some upside. I don't think the Swiss has got much left in it to the upside, unless we have some super risk-off event, which could do, but I don't see that on the horizon right now. So yeah, if we can come back down into this low, that would be a buying opportunity for me. I mean, you could even buy it right here. This is a really nice support level to possibly get long. The only downside here is you are buying against the trend. I mean, very, very strong momentum to the downside. If you want to try and fight it, be my guest. It's not really ready for me. I would need to see a trend change. I need to see his moving averages cross, price come higher, then I would be looking to buy. So yeah, let's see actually what's on the EdgeFinder quickly. So we got dollar yen. I don't think dollar Swiss is here, is it? No, it's not. Okay. Well, that dampens the idea. So yeah, possibly waiting on dollar Swiss to come a little bit higher might be the play, and then also wait for wait for the EdgeFinder to possibly align as well. Interest rate, surely they will be positive. J. Powell wants to fix dollar market. Your thoughts? What do you mean positive? Do you mean hawkish? It's not that simple, unfiltered real talk. Powell can't just come out and say, you know, I want the dollar to be better, or I want the dollar to be higher. So, you know, don't worry about inflation. Don't worry about the labor market. It's going to be, you know, I'm going to hike rates. It's not that simple. He's got to be unbiased in a certain sense. He's got to look at the data and perceive it as it is. And if it doesn't warrant a hawkish tone, then that's what it is. It doesn't matter what Powell wants in his head, really. James, I'm thinking about the same DXY. Yeah, I said this, I think at the start of the year on this stream. It might, anyway, give or take. It's very difficult to be a bear on the dollar, especially long term, because the US or United States, a very big player in the global economy in pretty much every sense. So it's not really like we're gonna or can start positioning for a huge sell-off on the dollar, unless there is something that really does warrant it. It's not something you would just sit and say, I don't really like the dollar, I'm going to start looking for it to come down about 50%. It is very unlikely to happen. So yeah, I think dollar upside is a lot easier to say than downside in my view. But yeah, we'll see, because we could see the dollar to continue to come down if we do have a dovish tone from Powell. I think it's expected we're going to get some rate cuts later this year. But I think Chris said it earlier on the stream. It's very likely, or pretty much guaranteed, we're going to get hold on this meeting, and then I think we're also expecting hold on the next meeting. So we might see the dollar quite stable in between that period, and because the markets are forward-looking, maybe later down the line towards the end of Q2, start of Q3, we might start pricing in those rate cuts. We'll see, or maybe even sooner. I'm also seeing retracement before upward momentum on dollar index. Okay, it seems like we've all got a similar idea on the dollar, and that kind of gives me the spooks actually. You guys are might be getting counter traded. We'll see. Look at the eco tab. Was it dollar Swiss? What we were looking at on the eco tab, Alan? What are you trying to tell me? Interesting. Gold's getting -3. Silver's getting negative. I really like the setup on silver actually, but just seeing that has scared me off, so I won't be taking this. But on the H1, it looks technically. Oops, that's not what I wanted to do. Hold on, give me a second. Technical difficulties. There we go. On the H1, the technical setup looks really good. I'm not in this position again, just for clarity, but we do have really nice structure through here. We've got the moving average trend change, so maybe upside, but again, that's just based on the technicals. If the economic indicators aren't supportive of upside, then I'm not going to take the trade. So yeah, that kind of wipes out the idea for me at the moment. We do have dollar CAD, dollar yen. Is that it? Can I scroll? Hold on. I think more technical difficulties. Yeah, here we go. New Zealand US dollar bullish. Okay. USD getting some strength, and the counterparts are fading. Gold is very bullish, now it's bearish. Also, US indices are very bullish now. Yeah, I agree, Alan. I think the US indices are still a really good play to make. They're just not quite there yet for an entry, in my view. Wait, hold on. Let me go back to H4. There we go. Yeah, so the trend changed on the H4 and then the S&P. this looks really good. So if we can just come back down into this level, retest this 200 moving average, then I would be quite happy to take this market higher and start getting in some longs. We do also have previous structure around here, slight resistance there, support previously here as well. So yeah, I like the S&P, I like the NAS, I like the Dow. NASDAQ, I was actually just looking at this when I was in the back. This monthly candle here is beautiful. Maybe if I was a little bit more of a risk taker, I would have tried to buy at the bottom, but you can always say that, can't you? You can always look back at the market and say, could have done this, could have done that, but it is what it is. But yeah, I think the NAS on a technical front looks a little bit better than the S&P. I think we could very easily come back down into this level, continue higher. But again, it's all very dependent on what happens tonight. Hold on. I think I've missed some messages here. Just market indecision ahead of Fed. Yeah, Lee, that's very normal. We often get sideways chop, especially ahead of FOMC. I'll tell you, the EdgeFinder is awesome. It confirms by fundamentals. Ball out, I totally agree. So he looks on fundamental data analysis. If it's like that, should be not worried then. Oh, you mean Powell? Okay. Yeah, pretty much in a nutshell. The EdgeFinder is this magical tool. So it takes it takes the economic indicators. So you got retail sales, services PMI, manufacturing PMI, GDP trend, inflation, and it will weigh up. So it will say, okay, the UK inflation is this, the US inflation is that, and it will give it a score of 1, 0, -1, essentially. And it will count those scores. As you can see here, we've got 1, 1, 1, -1. It counts them all up and gives it a final score. The final score will then essentially give it a rating of very bullish, neutral, bearish, or very bearish. You can then use that and apply it to a trade idea. It's not signals, it's not timing things, but it can help you decide whether a market is potentially ready to start looking for a trade, or it can confirm the idea. So for example, if you've got a really strong technical setup and it looks like a long position, you could check the EdgeFinder. If it's bullish, then maybe it's final confirmation. Or if it's super bearish, then it might scrap the trade idea. It just helps filter out those garbage trades that you might have taken. So if you want to buy it, make sure you use code ELITE. I do appreciate it. You could use code ELITE and help me buy a beer on the weekend. My fingers are itchy for more buys on buys to hold on gold. I'm going to be honest, I'm not sure I'd want to buy gold right now. We just saw it's got a bearish region on the EdgeFinder. It's very high. And I mean, you know, when I say very high, you could always make the argument we could look back in 10 years and it's still very cheap. But for where it is right now, it's very high. Would I want to start investing in gold, or essentially dollar cost averaging longs in gold right here? Probably not. This is we've got the high. Technically, this is now a lower high, especially relative from all-time high. I don't know. I think it's a little bit risky to start buying it right here. If you wanted to start dollar cost averaging into gold for the long term, I'd at least be waiting for this 3,000 level to get hit again, which might not happen. I don't know, but that's just my opinion, my view. He's notoriously hard to please, so that testament to its capabilities. Lee, yeah, I was thinking that. I wasn't going to say it though. The multi-trillionaire helicopter driver ball out likes the EdgeFinder. Still bullish on gold. Fair enough, LN. I'm not bearish on gold. I think it's a little bit naive to be bearish on gold. I mean, look at it. It's very difficult to set on a bearish perspective here. But I'm just saying, in terms of actually getting into the market, I think it's a little bit of a wrong time. Again, my view. Do what you want to do. Thoughts on oil. Oil's had a bloody nightmare recently, hasn't it? I did buy oil, actually. I actually don't have the price on me. It's on my other account. I bought it roughly, in fact, it's probably around break even now. Put it around here, give or take. And I'm looking to essentially just accumulate oil over the long term. So it's pretty much a position trade, just like my Swiss yen trade. Short term, I would expect it to continue lower. I just don't see anything really that's that supportive of oil. Now, the other side of that is I'm not an oil trader. I don't pay attention to oil really on a day-to-day basis, especially. So do your own research. But yeah, I just don't really see much there for oil right now. Let me just see what the EdgeFinder's got. It's not here at all, is it? No, it's not. It's not on here whatsoever. Do we have bullish? There's no bearish readings. So it seems like oil's quite neutral. Actually, let's just double check. Oh, wait, we do have... Oh, no, sorry, it is neutral. I think I might be being blind. Oh, it's here. Neutral, score of 4, slightly bullish. And obviously not actually bullish in terms of the reading, but the score of 4 is better than a score of -1 or a -4. So not too bad, but it's still not something I would really want to buy into, especially considering the trend of the market. So if you're looking for a short-term trade on oil, I would say downside is more likely than upside. But yeah, I wouldn't look to buy or sell it short-term. Do you think gold and silver are going to rise because of now Pakistan and India? Not really. I mean, that news came out yesterday and they didn't really amount to much. I think if it escalates, then yeah, potentially. But right now, it's not really that much of a big deal in terms of the markets. But we will see, of course. You know, it could always be a bit more significant. Yeah, but I think that's probably a sensible idea. Is waiting for oil to reach a certain point. I mean, you know, I can say about anything. Wait for it to reach a certain point and then buy or sell it. But yeah, oil's a commodity at the end of the day. It's not, in my view, I don't think it's going to continue lower. But we did have this discussion the other day, and I said it's very dangerous to say oil can't go lower because historically that's been proven to be wrong. It can quite literally go into negative territory. So yeah, again, do your own research. That's about all I've got for you on oil. It's not something I really trade. So yeah, the India and Pakistan, it will definitely be having some sort of effects, but it's not a main driver right now of the markets or risk. So if we have a look here, the risk sentiment is cautious optimism. It's been driven by earnings reports, China trade talks, Fed policy, and geopolitical tensions. There is no major factor at the moment for India and Pakistan. But again, if it starts to escalate, then yes, obviously, if we start seeing real threats, then yeah, there'll be problems. And when I say real threats, I mean other countries getting involved. It's a similar thing to sort of the Middle East. It kind of started out quite flat, and then it started to escalate quite quickly. Ranjit, good morning. It's also yen. Okay. I'm going to give you a little bit of education here. And I don't think I've ever covered this topic on this stream. I'm not sure why, but it's not something I really discuss that often. So what we've got to do with the yen, I'm still bullish, just to put that out there. But the thing is with the yen, it doesn't have, at the moment anyway, it doesn't have much of a reason to buy it. So we had the Bank of Japan come out pretty dovish. They're in no rush to hike rates, which is annoying, but it is what it is. They will hike rates eventually, and I will die on that post. But what I was actually talking about is the real rates of Japan. And real rates are something you've really got to pay attention to, especially if you're a swing trader or a position trader, because it's a huge thing. But yeah, I just don't really hear people talking about it that much. So real rates are a calculation. So let's call it real rates, not risk reward. We're talking about real rates, double R. And this is the interest rate. So let's just call it IR minus inflation. And that is the real rate. So what the real rate does is it tells us the true yield of a currency. So let me just try and make this make a bit more sense. So the interest rate in Japan at the moment is 0.5. The inflation is 3.6, if I remember correctly. It might be something different, but I'm fairly sure it is 3.6 right now. So that gives us a real rate of negative 3.1. So the yield that we're getting on this is bad, because when essentially the interest that we're earning from holding the yen gets taken away and some by inflation. So it's not a positive yield. So we're not really wanting to buy it just yet. It's not something that's that attractive. However, the markets are forward looking. So we need to also account for the fact that, yes, the Bank of Japan is on a path to normalization. Granted, it's very slow. We also need to take into account future inflation prints. So that's something to consider as well. So while I am bullish on the yen long term, short term, probably not something I'd really want to be getting too involved with. But again, that calculation works for every currency. You would do it for the dollar, the pound, the euro, Aussie, whatever else. Anyway, that's just, I wanted to put that out there because I think it's quite interesting. Anyway, just to get back on track, yen pairs, I think I would still consider going short dollar yen. I'm still in the camp of sells below 150, but going back to the thing I said about not really wanting to be involved short term, I wouldn't be really going in 1% risk on dollar yen. I think I'd be going in 0.25 here, maybe 0.25 here if we do get a rise up there. Then if we start coming above 150, I would cut it, scrap the trade, and start repositioning, and maybe get back involved going short dollar yen when we see the Bank of Japan turn a little bit more hawkish. So that's that. But yeah, that idea applies to pretty much every yen pair. I am involved in Swiss yen still. That's, again, it's a position trade. I've been very vocal about that. I'm still holding it, and I plan to for the next 1 to 2 years. Drone pumping indices to the moon today. We'll see. It would be quite nice. I managed to catch pretty much the bottom on the S&P on my investment account. So if we can get back to all-time highs on the S&P, that will be one of the best trades personally that I will have taken. They always say don't time the market, but if you can time the market and get time in the market, you got the best of both worlds. Central banks also opting out of US assets is another driver for gold. It is, yeah. Central banks are still buying gold. That is a key thing. So we do still have demand for gold. But I think, excuse me, this aggressive run may be slowing down now. I'm not saying it has. I'm not saying it will. I'm just saying I'm not really wanting to be involved with gold right now. It's just, yeah, I don't know. I think I would be taking a technical play, and that would be more just banking on the trend of gold. If we could come back down into the support, then come higher, I'd be quite happy to buy there. I was looking to buy this because if we draw the fib here, we had this level, but at the time gold was just dropping. I mean, we had this drop here, we had consolidation followed by another drop. I could not bring myself to just buy gold here. It was a bit too risky for me, so I avoided it, and now I'm a little bit salty that I did that. I'm kicking myself, but it is what it is. Deepak, I appreciate it. Thank you. Greetings, Professor. I've never been called Professor before. Please, how about USD CAD? Why CAD is so strong and correlations with indices weak? Can you explain this? I'm not sure what that means exactly. Let me. So you say, why CAD so strong? I'll be honest, CAD isn't that strong. Let me just check something quickly. I've not really been paying attention to the Canadian dollar. Let me just have a quick look at something here. Yeah, the CAD isn't really that strong. It's actually pretty stable. It's hanging around neutral in terms of strength. The US dollar, however, is underperforming the CAD, which is why it seems like the CAD is so strong. It's just because the US dollar is pretty weak. Canadian dollar is actually relatively stable. So it's causing this dollar CAD drop. But yeah, that's pretty much it. Let's just see. Oh yeah, this was what I was looking at the other day. So this level on dollar CAD looks really attractive to go long from a technical standpoint. We've got a really nice structure through here. Break, potential retest. However, can't buy it because there's just no other confirmations to buy dollar CAD right now. Let's actually just check. I closed it. Yeah. Is dollar CAD on here? I think it might have been. No, it's got a score of 3. That's pretty. Yeah, not something I want to be involved with. So dollar CAD, yeah, nothing of interest there. New Zealand dollar. I think New Zealand dollar's pretty much. Actually, we do have a score of 5. Let me just pull this up for you. Give me a moment. Yeah, here. So dollar CAD, sorry, not dollar CAD, New Zealand dollar, score of bullish, score of 6. We've got COT flat, retail flat, pretty much 50-50. Seasonality is bearish, trend is bullish, GDP is bullish or favoring New Zealand. Manufacturing is negative, inflation is positive, unemployment. So it's not the strongest. It's not something I'd be rushing to go and buy, but I would be more on the side of going long New Zealand dollar than short. So I think what I would want to see here is this trend change of the moving averages, pull back potentially into the middle of the moving averages or somewhere into the moving averages, then continue higher, back into this previous high, I think would be quite nice. Then that'd be quite a sensible trade to look for. The other option is using the fib. We look for this 0.5 to 0.618 pullback, and then we go along off this level and then continue higher. I'm not sure we're really going to see it go that much lower from here, but yeah, we'll see. Trend is pretty aggressive to the downside, actually, if we zoom out on the daily. So yeah, if we get that trend change, that might be a sign to buy, or at least a sign to look to buy. Dawn, hello. Good to see you. Okay, so yeah, there's not much else to discuss. So far, well, yeah, FOMC seems pretty straightforward. Very, very likely we're going to get a hold. Very likely Powell's probably not going to say that much. More than likely just going to data dependent, blah, 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 blah. As always, then we don't do anything. I know we probably get a hold on the next meeting as well, but obviously we have to stay data dependent as well. So yeah, that is what it is. Hold on, let me just have a look at something here. There we go. So COT, very short Swiss, very long yen. Actually, that's really nice for the Swiss yen. I didn't even pick that up. Swiss yen shorts are being backed up by the COT positioning. The Nikkei net position is actually pretty flat at 39. It's not really that meaningful, but they have added long contracts, reduced shorts. Dow, similar thing, long contracts added. And you will notice this is pretty risk-on behavior. I mean, the NASDAQ actually isn't, which is interesting because NASDAQ is quite a strong buy on top setups, but short contracts have been added quite heavily. Long contracts added, but very negligible or meaningless really at 363. So yeah, net change is negative 0.37. Overall position or net positioning is still bullish, but this addition of shorts, I don't really like that. Euro. Actually, very bullish behavior on euro. Large amounts of shorts taken off. Overall, yeah, pretty bullish. Net position is bullish. Okay, interesting. I've got about 15 minutes left on the stream, so if there are any questions, please let me know. I'm not sure who's on after me, actually. So you've got Nick after me, then you've got Alan Perez, then you've got Nick again after after Ireland. Okay, right. We've looked at COT. Let's have a look at retail. So I don't care about indices, commodities, metals. I want to pay attention to major and minor currencies. It's not really changed too much. It looks like retail might have caught on to the Swiss yen short idea. Maybe I should have kept that in the back pocket. You think all of retail are paying attention to the A1 show where we're discussing Swiss yen shorts? I don't know. Maybe. I don't like that though. Although, actually, I suppose it's a good thing. If the market goes higher, does mean I can add on more positions, which is completely fine with me. Dollar Swiss, majority long. Euro Swiss long. Euro Swiss, actually, I do quite like the idea of that. So again, I'm not... Yeah, I just don't really like Swiss long. So I quite... Or yeah, I think I prefer to be going short Swiss. As I was saying earlier, I don't think the Swiss really has any room to go higher. It could obviously, when I say higher, I mean it could obviously come higher, but I don't think it's sustainable. I think if it does come higher, eventually we are going to get met with the S&B intervention to bring it down, back down lower. I'm not in the position, by the way. So yeah, Euro Swiss longs make sense. We do have smart money buying the euro. If we're switching from a risk-off market back to risk-on, that's also supportive. So we did have a risk-off market, which supported this this upside in the Swiss that we saw. So if we're coming back to risk-on, we could see outflow of Swiss back into euro. So yeah, we'll see. But yeah, I think Euro Swiss definitely makes sense, just from a sentiment perspective. In terms of the fundamentals, we've got the S&B is still expected to go into negative, still has the possibility to go into negative rates this year. Although the ECB is also not really that hawkish at the moment either. So there is that. Hello, James. What do you think about gold with interest rate Fed today? I'm going to be honest, Forex God tier. I think it's going to be quite flat. Don't forget, interest rate decisions are already priced in. So unless Powell comes out and says, we're actually going to cut rates 25 basis points, we're hiking rates 25 basis points, as long as he holds, very likely we're not going to see anything. It's pretty much guaranteed gold's going to stay flat. What could move gold, though, is the statement afterwards. So if Powell comes out very hawkish, very dovish, that could also move gold. But again, I would expect it to be pretty much neutral. So I'm not expecting anything tonight in terms of market movements. I would be quite surprised if we do get that. What's my chart of the week? I don't have a chart of the week. I've pretty much been away from the desk all week, really, or away from the charts. I'm currently building another company, which I may disclose. Well, we're going to launch it in August, so I'll let you know then, but staying under wraps for now. So yeah, not really trading that much at the moment. How do you trade COT? Dorian, you wouldn't trade COT, really. It's not something you would look at and take a trade based on it. You would more use it as a, excuse me, you would use it more of a sentiment gauge. You could also use it as a confirmation. So let's say, for example, Euro Swiss. Let's say you wanted to go long here on a Friday. It comes on Monday. We know, or we got a flip in COT. So we, hypothetically, of course, we see smart money heavily shorting Swiss. We see them long in euro. And you've already planned this idea. You're looking at the S&B, the ECB, you're looking at inflation, whatever else there may be behind the trade. You use that COT data as confirmation. What you wouldn't do is sit here on a Sunday or a Monday and say, oh, on Friday, smart money just sold Swiss and bought euro. I'm going to buy. That's not really a good way to trade because COT, first of all, is a lagging indicator. It's a week behind. So it's not like Monday morning institutions get to the desk and start clicking buy on euro, sell Swiss, or whatever else you're looking at. They've already done it. So there's that aspect as well. So yes, the COT is very, very powerful. It's very good, but it's not a signal, if that makes sense. It's more of just a confirmation tool or an indicator, if you will. So yeah, Sorry, guys, just got to read a quick message. Give me 1 second. I can't ignore it, unfortunately. Apologies, this is really unprofessional, but I just need to check something real quick. Okay, fine. Cool. I am back. You've got my undivided attention now. Okay, so as I said, we've got about 15 minutes left. So if there are any questions, please let me know so I can answer them. If not, that's completely fine. We can keep yapping. I'm pretty good at yapping, actually. It just happens. Okay. So let's have a look at gold and silver. I know we've spoken about gold and silver, but let's have a look at the data behind it. So gold is actually quite neutral. Score of 4. So again, it's not really. It's more supportive of longs and shorts, but it's not something I'm going to rush to buy right now. It's based on the indicators. Seasonality is bullish for gold. Problem is with seasonality on gold, most of the time it is bullish because seasonality obviously takes into account historical price movements of gold. So we'll say, January, historically gold moves 1% or 0.5%. So gold, same thing with the S&P. I mean, the S&P is a little bit more accurate, but gold, and especially G10 currency pairs, is not the best to use, really, in my view, because gold pretty much just moves up anyway. But things like the S&P are a little bit better because you can get like the Santa rally, you can get the summer cool down sometimes where when traders step away for summer, sometimes you can see the S&P start to drop off or at least flatten out a little bit. So yeah. What webinar is this? What do you mean, what webinar is this? It's not really a webinar, to be honest with you. It's a live stream. It goes on every day. I'm just a guest. It's not my stream. But I come on 2 or 3 times a week normally. Sorry, just joined. What about Aussie dollar? It's all right. You don't need to apologize. I don't know, to be honest. I've not really looked into the Aussie too much. I wouldn't say it's necessarily that supported. I think a lot of the dollar crosses at the minute are being driven purely by dollar weakness, not necessarily the cross assets bullishness, if that makes sense. That's just my view. However, it depends on your view on the dollar. I personally am not necessarily that bearish, so I'm not really looking to go long, although the trend is very bullish. So it would more indicate long than short. Let's just see if it's on the EdgeFinder. I don't know if it is. No, it's not. It's actually it's completely neutral with a score of 1, so it doesn't really give us any indication. What I would say, if you want to trade a dollar cross, in this situation, Aussie dollar, wait for tonight, pay attention to the statement. So you would say, okay, Powell's neutral, actually it doesn't really change anything. I'm just going to have to sit out, or I'm going to have to trade the range. Or Powell's dovish, is hawkish, whatever it may be. Take that into account, start planning for the next Fed, and look forwards as the market looks forwards. So yeah, sorry. I know that's probably a really boring answer that you didn't really want to hear, but yeah, there's nothing I can really tell you on Aussie dollar. It's pretty much flat. In terms of just price action, though, I would more go long, and that's just because we've got the upside trend. We've broken above this previous level, so yeah. Again, just trend trading is typically just buying into the trend. In this case, upside. Any corrections down? Just DCA longs. Ball out. I respect the DCA, but I can't go a dollar cost average short dollar. As I said earlier, I just can't. I can't be shorting dollar heavily. Can't bring myself to do it. That's why I love dollar cost average euro dollar shorts, because that always puts me on the side of the US. Wait, no, ball out though. If you're dollar cost average longs on Aussie US dollar, you're shorting the US dollar. Is what I'm talking about. I'm talking about the US dollar specifically, not the pair. Okay. Right. So the FTSE, actually, I forgot to mention the FTSE. That was a big one, and I've kind of just left it on the sidelines because, as I said, I'm not really trading at the moment. But this was a big one that I really wanted to get into. And you can see I've got the alerts that's still set. And to be honest, I may actually take this tomorrow. Very dependent. I'm just going to delete these for now, just so we've got a clear chart or a more clear chart. What I would like to see on the FTSE is a pullback into this moving average, continue to the upside, because this would also retest this level of previous structure. Very typical break and retest pattern. I think we all should know that by now. And then take it back into previous highs. The reason I wouldn't look for new all-time highs on the FTSE is just because of the typical market behavior. We've discussed this previously, but for anyone that hasn't heard me say this before, the FTSE behavior is horrible. It's one of the worst markets, in my opinion. It's just sideways, really. Of course, you get some upside, downside, as you do with every market. But the general movement is sideways. It's very, very good if you're short-term trading. You can essentially buy support, buy resistance, sell support. No, wait, sorry, buy support, sell resistance. So that type of trading works out quite well in the FTSE. But speculative swing trade on FTSE is very, very difficult, really. So I would be looking in this situation just for a long into these previous highs. And the reason long FTSE is because Bank of England is cutting rates. Although maybe not super aggressive, but that rate cut does play a part in FTSE longs. So we'll see. FTSE, yeah, FTSE. Actually, let me just see. It was at one point, it still is. Score of 12 is really good. So we also have the EdgeFinder that backs up longs on FTSE. Dow and Nasdaq as well. We're in a very classic risk-on market. You can see New Zealand dollar bullishness, S&P bullish, Russell bullish, FTSE, Nas, and Dow all very, very bullish. So, yeah, typical risk-on behavior by, or risk-on readings, at least by the EdgeFinder. So the Dow is actually in the lead at the moment. I really like this. Depending on Powell, this may be the next trade I take, actually. I really like this technical level. We've almost got this trend change. The data is supportive of longs. Now, I wouldn't... Yeah, I'm just trying to think of the best execution, because I would love to be able to dollar cost average this, but I'm just not sure that's actually the play right now. I think I'd rather just wait for a technical entry than consider a dollar cost average after that. So yeah, maybe if we could even get a pullback into this fib level, this 0.5618, I think that would also be a pretty strong entry point here, and then continue higher. Now, as I was saying with the FTSE and not targeting all-time highs, I think the Dow is a little bit different. You could, in theory, target new all-time highs with the Dow, because the behavior is the opposite of the FTSE. It is very, very bullish in the long term. So if you manage to get into a position, and let's say, hypothetically, let's say you did enter around here on this 50% pullback, stop loss below the lows. Actually, let me just draw the trade. That'd be easier, wouldn't it? Do something like this. So let's say you got into this trade and price was just running up, something like this, trail stops here. You could essentially just hold this trade for a year, obviously assuming that you're not going to get a stopped out break even or whatever it may be. Hypothetically, if you manage to get a really strong entry on the Dow or the Nas or the S&P, this could turn into a position trade with a swing trade type stop loss. So the R&R would be incredible. Now, again, this is assuming that everything goes perfectly, but it's not impossible. So it's something I'm paying attention to. I think if I did manage to get into the Dow or the S&P or the Nas with some sort of entry like this, and we did see it run up and start breaking previous highs, trail stops, remove the take profit, and just let it run. You thought this was Chris Pulver's stream? No, this is Trader Nick's stream. So Nick, depending on the stream, Nick typically comes on for the first was it like 1 to 2 hours? Then he'll have a guest on, and then a guest after that. Then maybe he'll come back to it again, depending on the stream. But yeah, no, it's just in this stream. I think Chris came on first. Normally Chris is last. It's kind of a reverse Uno stream today, because actually Nick's on last today as well, so completely flipped it around. I think the DXY goes back to 104, then drops again. My opinion, I've never heard of an opinion before. Let's see. Yeah, if I'm looking for the dollar to, oops, that's not what I want. If I'm looking for the dollar to come higher than lower, I think I would just use very simple technicals. Look for this fib. So look between this 61.8 and the 0.5. So yeah, in fact, your 104 idea is pretty much spot on. So if you are sitting bearish, you'd want something like this where you come and intersect this and then come lower. So we'll see. So it's basically two plays. You could either look for the 50% retracement, then short, or you would look at it in terms of the COT. Smart money is buying the dollar. We're at a very strong weekly, monthly level. So yeah, there is that. What I'm just going to do is actually pull up the US heat map. So yeah, even the heat map's pretty much not telling us anything really. It's slightly bearish with 46. Obviously, it's under 50, so not the best, but it's not really signaling anything. So in terms of where the dollar could go, I'm pretty much flat. I would, again, I've said it before, but I'll say it again. I would sit more on the bullish side short term. But yeah, there isn't really a strong way to gauge dollar direction right now, in my opinion. Okay, sweet. God, I'm starving. Starving Marvin. Also, if you get that reference, shout out to you. Sans. Forex God's here, no problem. So this is what Swiss yen's looking like. I forgot to go through my open trades, so we can do that for the last 5 minutes. So Swiss yen, I had a position here. I think it was around here. I took off this top position just to accumulate some profit. So this position stayed here. I cut my higher position when we came, I think I cut it around here, made about $600, which was quite nice. Because and this is one of those things, when you've been in the markets for a while, you'll get this gut feeling, this discretional thing, and I can't explain it. The only way I could really try and explain it is this aggressive candle here. And I've said it multiple times, but candles like this generally get filled or corrected. So when we had this, I was like, you know what? I'm going to take the profit or take some profits, wait for the pullback into the same level where I sold initially, and then just re-add in. So I just got $600 for basically free. So I've not actually added in yet. I'm just seeing how price reacts for the next couple of hours after FOMC. But that's the plan. So that was actually pretty straightforward. It's probably the easiest $600 I've ever made. The Aussie Swiss trade's coming back down to entry. This wasn't my trade. I actually don't have the analysis for that one, so I can't really cover it. I am euro dollar long. This trade has been an absolute pain. I think Nick's actually in a similar position. I think he got a better entry than I did. But I'm really considering cutting this one, actually. I think it's a little bit late. I may as well just wait for FOMC because it's in, what is it? I'd say roughly 0.2, 0.3% drawdown, give or take. And to be honest, I'm more than happy to just sit through FOMC. As I said, I don't expect that much. We might see a little bit of chop, but I wouldn't expect a euro dollar to just tank either way, upside or downside. What else do we have? We've got New Zealand Swiss actually just got, well, yeah, absolutely blown through. This was one of those trades. I actually did very well on this trade, even though it doesn't look like it. I did. So I took this trade on two different accounts. I took it on a Darwin trade, a Darwin X account and on a personal account. Thank God. I'm saying thank God because I'm going to be honest, it was more of a, I don't like saying luck because I think luck is a very poor thing to rely on in trading, but I'll be honest, it was a bit of luck. I was asleep last night and I woke up. I can't remember why I woke up. I just did. I just woke up and it was a headline. And there was two headlines. There was one from the Pakistan and the Indian situation. There was another one saying that the UK is aggressively or intense, I can't remember the wording, trying to find a deal with the US regarding the economy. I was like, oh, whatever, I don't really care that much. I'll go back to sleep. Anyway, I checked MetaTrader. This trade just flew on market open, just flew to the upside. So I closed it on the personal account, left it to run on Darwin. Darwin got stopped out. So I made a very nice profit on personal account. Darwin obviously hits a 1% stop. So I'm actually not too bothered about that trade. And that's, is that all the positions? I thought I had another one. Yeah, no, that is it. Okay. Well, that was it. So, yeah. But as I said, I'm not really doing anything at the moment. So that's why I'm just letting these trades run, because I'm quite happy to not really be that involved in the markets at the minute. What else is there? I think that is pretty much it. Euro New Zealand, potential short, actually. Trend is quite nice here. Although I don't really have a fundamental reason to go short on Euro New Zealand. But I quite like this. Trend change, small structure here. And again, this is just from a technical basis, possible downside here. Although fundamentally, I actually think Euro New Zealand is quite bullish. But again, I don't have the analysis to back that up right now. Anyway, guys, I've just realized I've slightly run over, but I've not had a message or anything, so I don't know if Nick is ready to take. Actually, is it Nick? Yeah, it is Nick. I assume I'll get pulled off when time comes. Anyway, it looks like I'm getting pulled off now. Oh,
hey,
Nick.
James.
Hey,
what's
Nick.
up, man? How you doing? I was listening to your analysis. I was like, hey, keep going. I'm enjoying the commentary.
Yeah, it's another one of those days. Unfortunately, I just don't really have that much going on. Yeah, unfortunately,
I've been stuck in kind of a grind too, where I'm like, there's a lot of trades that I like the idea of. Like I like the indices long right now, but I'm just stuck where I'm like, well, I can't justify chasing, but I'm like, okay, if the trade pulls back, the problem is I've been in that mode for like a lot of trades in recent times, which is frustrating. It's just part of the grind, I feel like.
Yeah, no, I've got a very similar thing with the US markets at the moment. So the S&P, the Nas, the Dow. In hindsight, I'm looking back and I should have bought that, when it hit the 200 weekly moving average. I should have just taken the risk. Should have done it. But at the time, it was like, I can't do it. It's selling off too aggressively. It's one of those times the markets are just very, very tricky to find a solid swing trade idea on at the moment.
Yeah, I've been actually doing a lot of FX here recently. I went long. I saw you talking about the Kiwi Swiss franc. I just bought recently the NZJPY.
Okay.
Very small size because this looks a lot like the indices where they've run up. It's run up a good bit. I may get better entries if this thing goes down. I know you and I kind of share a similar dollar cost averaging style, so I'm looking for if I can get it push up to this 87 level and beyond. I do think that if you break through that, you may have some upside in the Kiwi dollar, but we'll see. It's been interesting. You've had kind of like this big dry up in volatility. Of course, going into a Fed day, we may get a big spike in volatility, but we've seen that in the indices too, where we had these ginormous moves. Look at the size of these candles, and then now we've kind of slowly grinded back towards just a little bit more of a boring market. You could see it also present in the VIX, where you had this big run up in the VIX and now kind of collapsing back down. But still, just a heads up to everybody, this is still elevated volatility implied in the market. That tells you that, at any moment, the market could still move pretty substantially. It's still expected to move much more than it was expected to move early this year, early February, so on and so forth. So just something to think about.
Yeah. There's still a lot of uncertainty in the markets. I mean, I think people are sort of forgetting at this point, but the tariffs, it's not done. It's just paused. So there's still something to account for. There's still deals that have been talked about. There's still anything could happen. China could say something, the US could say something, Europe could say. It's one of those things where we're quite literally stand on the edge of a cliff. So even if we find, there is a perfect condition, it takes one person to say one thing, one headline, the trade's ruined, or take profit. So yeah, it's tricky times.
Yeah, it is. I want to show you something, James, because this is so I am bullish on the indices, but let me show you an example. I've been talking about this a lot on my channel recently, where when you had this market in free fall, you had bears like really loud, really confident about how the market's going to crash, and we know that that's oftentimes when everybody is euphoric or everybody is fearful. That's usually a sign that the bottom is pretty close. But I wanted to show the other side of that because I did a lot of bear bashing in my last few weeks. But let me show you just an example of one of the most respectable bear cases that I've seen here recently. So this person in our Discord put together what I think is the most feasible, responsible bear case that I've seen being a bear in the stock market. Like, again, I don't really see the vision when people are like, oh, I'm getting short, I'm buying puts like aggressively when the market is in free fall, because at any point you get these 10% snapbacks, which can really crush people who are, over leveraged or making big bets that the market's going to fall. But this right here, this is a good example to everyone. If you are bearish on the indices, let this, in my opinion, be an example of what bearishness with proper reasoning looks like. Macro trader within the group says NQ trading above Liberation Day highs before any trade deals have even been announced. Number 2 point, the rally is likely a bull trap as it is not backed by volume or liquidity. Number 3, FOMC is likely to be hawkish as we see sticky inflation and jobs data holding together, which is fair. I think there's likely going to be some continued kind of standing still in terms of Powell. And then 4, rejecting the weekly supply and 61.8% retracement level, also forming a head and shoulders on the 1 hour time frame. So here's a person who's mapped out, coming back into key moving averages, pulling back after having, flushing out a lot of the overzealous bears. We're now seeing, a lot of the bears gave up already. And so, I'm a bull, but I can heavily respect this perspective. That's what I would just say is like when somebody asks you, and this is good for everybody who's listening to the stream, right? If somebody says to you, why are you bullish or bearish on something? This is what you should be able to do every time. This is mapping out your logic, bullet point form, simplified with screenshots attached. James, I know we offer 2 different services, but whether somebody signs up and joins your service or they join our service, I know one of the common threads is that there's analysis, there's breakdown, there's understanding. This is an example of what a quality trade idea is looking like. This is not somebody who's even like, this is not part of our paid service. This is just a member doing a great job writing it out for us. I just wanted to get your thoughts on that. Isn't that a pretty good example? I saw that. I was pretty impressed.
It's very good, yeah. And to be honest, that's actually kind of swayed my thinking a little bit. I was watching a video today actually by Anton Creel. I'm sure many of the stream know who that is. And it was an old video, but he was talking about one time when the stock market was heading down. I can't remember the full story, but it was essentially him and one of his colleagues at Goldman Sachs were down about $400 million. Because they were shorting, I think it was the NASDAQ, and they were in some serious trouble. So what they did was they went and got long on Euro stocks to offset some of that risk. Then they saw the NASDAQ head slightly further down while they were still in what we would call drawdown. So they closed out Euro stocks for a loss, got back in at NASDAQ, slightly higher price, brought their average up, and increased and got short. But it's very similar to what you just said in terms of the bears getting squeezed out, the overzealous bears, because it was basically the same thing that happened back then when even institutions were in pretty big red territory, just waiting for it to continue lower to add in again.
Yeah, no, I mean, at the end of the day, it's just, I go back to this concept here of looking at something like the put to call ratio or just sentiment indicators in kind of entirety. You don't necessarily have to look at this one. This is my favorite indicator to look at, the put to call. But the basic idea is simply put, like, look at how extreme the bearish sentiment got at the bottom of the market. I mean, this is the bottom of the market and people are absolutely, convinced the market's going to crash. That's just how market psychology works, is you have to be very careful. Now, and James, I know I got to let you go because you've been on the stream for a while. So I'll let you go in just a second. I was just going to finish that. Yeah, I was just going to finish that point with, basically markets, sometimes the consensus is right, but rarely when it gets to very extreme levels is consensus right. Usually when levels like this occur, this is almost always through history. Go check the put to call ratio throughout history, and you will see what I'm saying is true. Almost always when it gets to these extremities, those are turning points to the upside in the market. Even if there's a reason to be bearish, even if the bigger term picture for the next 6 months is lower in the markets, just be very careful when you get these sentiment extremes. We've seen things normalize a little bit, but markets are still fearful. I would say, again, risk reward still kind of looks okay for the upside based on that. But again, that person and everybody in this room, I think, did a great job at preparing their reasonings for why they wanted to get short. And anybody who is, whether you're bullish, bearish, whatever you trade, having some sort of game plan mapped out like that, I think is a really good lesson to take with you.
Yeah. Last thing I would say is, even as you said, sometimes the consensus can be right, or the masses. Even in a situation where they are right, a lot of the time the market will still go the opposite way, wipe them out, and then continue in the same direction that they thought it was going to go.
Yeah.
Whether you want to call it, retail hunts or whatever you want to call it is fine. But it's a very typical market behavior. Whether people get taken out, then the market continues.
Well, yeah, and the idea that like you can call it a liquidity sweep, you can call it a stop hunt, whatever you want to call it. I honestly think that those are fun, fancy ways for basically saying when sentiment gets extreme, it's way harder to impress the crowd. What I mean by that is that over here, when the market was like absolutely euphoric, Donald Trump's going to, take us to the moon, and companies are going to be more profitable than ever, and no regulation, and crypto is going to be like to move the needle higher took so much. The market was so demanding. Everybody was convinced it's going to go higher. So then when you actually had some negative news, it didn't take a lot of that to get the market to really crash, right? So sentiment operates, you could call it a stop hunt if you want, but it's basically when sentiment gets all one-sided, right? You get these big snaps back the other direction on any sign of opposing views coming into the market. So just something to think about. Sentiment is really, really powerful for those great risk to reward setups. James, I want to just really quick drop a plug to anybody who would like more from you. You spent the last hour here sharing some ideas and market analysis with everybody here on the stream. A1 Trading regular contributor James is, and if you are not already subscribed to his YouTube channel as well, check him out. Forex James, his link is in the chat right now. Do us a favor, make sure to go subscribe, check out some of his content. And James, thank you very much for coming on the show today, man. Appreciate it.
Cool. Thank you, Nick. See you later, guys. Have a good day.
See ya. All good stuff as always. Again, James is one of our most popular guests on the stream, and you can see why. He's really collected. His thoughts are well collected. He describes what we're talking about here, like this person that I just got done praising. Right, this way. What you'll notice is that a lot of the great trading content creators strive to do this in video format, right? I try and do this kind of thing in my video format, which is just to map out ideas for why I have a bias on a certain currency pair, commodity, etc. So earlier today, I took a trade inside of the Discord room, and I'll show you an example of what one of my trade alerts looks like why or how I map this out. So I went long the NZD JPY currency pair. Here is the reasoning behind the trade. So all of this is my reasoning for the trade. So with every trade, I try and do my best to map out an expression of why I like a certain chart, long or short, and kind of my game plan for the trade. So I bought NZD JPY around current levels, and I plan to try and see if I can get a bigger breakaway move. We are seeing some good progress on the Kiwi yen in terms of price action. I discussed this currency pair yesterday on the stream and sent out a trade alert here just a moment ago, or just a little short while ago. If we pull up NZD JPY, I'll just map out the idea behind the trade. So we had a really nice breakout of a key level of resistance. Here we had resistance, clearly a big sell-off there. Here we had resistance, sell-off, but then found support and we were actually able to push through and close above that level. So on the daily candle, right, we had a close above, and then we've had a couple days back down into this current level of support. So I know this is a very brief pullback, and so I'll map out my game plan with this trade. I'm not all in long Kiwi yen right here. I have a small initial long position here with willingness to add to the trade if it goes against me back down to this level. So I like both of these levels for long side continuations of this currency pair higher. I don't know which of these levels is going to perfectly hold. I think we could get a bounce here. That's why I'm long. But if we don't, I also like the idea of adding into the trade here and getting a bigger size. So I have both scenarios ready. I like the long side of this currency pair on a technical basis. But now let me show you just quickly the reasoning behind the trade on a fundamental perspective. So shortcut version is to quickly look at the economic surprise meter, which shows me which currencies and their respective economies are surprising economic forecasts most often recently. And New Zealand, as you can see here, is getting a 75%. That means it has a very high or upbeat economic data prints recently. We compare that to Japan, which at just 44 is much weaker than the rest of the group for the most part, other than the Canadian dollar. So when we look at the NZD JPY currency pair, we're talking about an economy that is upbeat right now relative to forecasts. And that is the key. Relative to forecasts, we're getting some upbeat economic data from New Zealand compared to Japan, where we're seeing a little bit of a miss. So if I pull open, I could go deeper by going to the New Zealand economic heat map, and you'll see that most of our indicators for the New Zealand dollar, when looking at PMI numbers, GDP growth numbers, etc., are coming in better than expected. Like, for example, we had GDP growth come in at 0.7 compared to 0.4%. Now, why is this red? Well, because 0.7% GDP growth is still not super impressive, but this is a heck of a lot more impressive than what was forecasted by analysts, right? We also have 53.2 in terms of manufacturing PMIs, 49.1. So we saw a slight uptick from the previous report on services PMIs. Retail sales, relatively strong. If we take a look at unemployment rate, 5.1%. So it came down relative to forecasts of 5.3%. Long story short, we have some pretty good indications right now that the New Zealand dollar has been upbeat. The Bank of Japan, or I'm sorry, the Japanese yen has had the opposite effect. The Japanese currency is getting some weakness to it due to missing some of their expectations, right? Unemployment rate actually ticked higher. GDP growth came in a little softer than expected. Do you see how we're mapping out, we're comparing these two currencies based on their economies? Does that make sense? Do me a favor. Chat's kind of quiet really quick. Just do me a big favor. If you could just let me know if that makes sense by typing yes in the chat or putting a 1 in the chat. If you understand the breakdown that I just did, I know we did a really rapid version of it, but we compare the strengths of these two economies. And then we look at the technicals, and that is ultimately, in my view, a much better way to look at currencies. Most people look at currency pairs just looking at candlesticks. In my opinion, we want to look at the underlying, we want to look under the hood and say which country is showing some strength, which country is showing some weakness. And one of the easiest ways, if you have the EdgeFinder, is to use this new economic surprise meter chart. I love this new page so much. It is so quick and so easy for me to compare which countries economically are upbeat and which ones are downbeat, right? So a higher score, we could read this together. A higher score indicates that the majority of key economic metrics like GDP, PMI, CPI have recently been strong relative to economic forecasts for the currency. A lower score indicates that the majority of key economic metrics have recently missed their expectations relative to economic forecasts. Okay, thank you guys for the yeses in the chat. So appreciate that. But yeah, so again, I look at this pretty much every day now. This is so simple for me to get an idea of which currencies I really want to be more long focused on and which ones have negative trends associated with them. So quick way to look at this, of the majors, right? Here's your majors. This is your major section. The strongest in terms of economic upbeat or downbeat readings. The UK is getting the strongest relative outperformance to its forecasts. New Zealand is number 2. Number 3 and 4 tied, Australia and Switzerland. And then we can go down the list. We could say Euro is next. US, then Japan, then Canada. So again, I'm using these gauges to simplify the process and define Forex setups. I trade Forex, I trade indices, I trade commodities, I trade a bit of everything. And I'm always looking for tools to simplify the analysis process to spot those opportunities. So I am, like I said, I'm long NZD JPY. I like the upside for this. But you have to understand, I just mapped out a trade plan for why I like this currency pair. I'm not going to bet the farm on it, right? I'm going to bet a small amount of money that this thing is more likely, in my view, to go up than to go down. Is that a guarantee? No, that's where most new traders get this wrong. I can map out all those ideas for why I think New Zealand, the New Zealand dollar against the Japanese yen should do well. And I could still be wrong. I could be wrong. This thing could move lower for the next few weeks. I could be dead wrong. Something could change in the data, right? So my point is, we want to be looking at things from a probabilistic standpoint. That's a Forex trade that I currently like. It's not a guarantee that it's going to go up. It's just a best guess, best educated guess on which way I think this market is likely to move. And if I'm right, I'll make some money. And if I'm wrong, I'll manage it. And if I lose money, it's not going to blow me up, right? It's not going to destroy my account because I put a huge risk on the trade. I've done this on YouTube since 2018. And throughout that whole time, I've said that probably, I'm not even kidding, probably tens of thousands of times. Position sizing is ultimately the number one thing that traders get wrong. They mess up almost every, think about this for a second. Everybody in the chat, think about this for a moment. If you've ever had a really bad experience trading, like you've blown an account or you've had an emotional freak out or something just went terribly, terribly wrong. If I guess this correct, type yes in the chat for me, okay? My guess is that something could have been made way less bad if your position size was significantly smaller. If that was you, and I'm self-reporting, that's totally me too. Like almost all of my problems in trading from like when I first got started in this stuff and it was difficult, almost all of it, guys, stemmed from sizing being inappropriately large. Almost always, almost every single person in this chat, I feel like that's my hunch. You let me know if I'm right. Type yes in the chat. If you've had a bad experience in the markets that was largely to blame because your position sizing was inappropriate or just straight up stupid, type yes in the chat. Because I'm telling you, I think that's all of us. That's going to be my guess. I think everybody in this room knows what I'm talking about. And if we could just kind of collectively be like, yeah, silly position sizing is the root of almost all problems in trading. If we could all get on that same wavelength, holy crap. Like we could just significantly improve the trading community. Okay. So again, we got a lot of yeses in the chat. Definitely happened to me. Guilty as charged. Happened to me after revenge emotion. Yeah, that, oh man, same. I've been there, right? Anybody done that one before, right? Getting really frustrated and then you go full tilt and put a big size on. That's certainly happened to me, right? Heck, that's easy to do even when you've been doing it for years, right? Tilt is a real thing. Tilt in trading, ooh, man. Like tilt in a video game, that's child's play. Tilt in trading, that can ruin your life. Like you got to be careful, okay? Like if you're tilted playing video games, you're tilted playing sports, at least, you know, the worst thing that can happen is like you say something stupid to somebody and it's, you know, in trading, going full tilt means you can set yourself back years financially. So let's not do that. Okay. That is, that's why this stuff is no joke, right? You got to be really careful. And a lot of people make that mistake. I lost $7,000 a few weeks ago because of that. Basically inappropriate position sizing, but I made it back, learned a huge lesson. Yeah, I mean, that's the thing is the other thing too. I'll tell you this. You ready? You ready? Anybody want to skip the line if you're new to trading? Actually, can I just ask you guys in the chat really quick to give me some feedback? How long, and be honest with me, even if it's 2 days, even if it's 2 hours, how long have you been trading? Drop it in the chat really quick. I'm just curious who we're working with. I know some of you guys have been around for a long time. Some of you guys are brand new to this. No shame. How long you been in the game? Just let me know in the chat really quick. How long have you been trading? Is this week 1 for you? Day 1 for you? First year, first 2 years, first 5 years, first 10 years. Let me know. Anybody brand new to this stuff? If anybody's brand new, like, I'm not going to lie, you are in a great spot. I know that sounds arrogant, but like, please consider subscribing if you're new. I'm telling you, I do my very best on this channel. I've gone through, it's kind of like when like, what's that? You guys know the All's Quiet on the Western Front? Has anybody seen that movie? In that movie, all the kids are like so excited when they first get like recruited to be soldiers, and then they very quickly like grow up, learn hard lessons. That's like what trading is like. Trading is going through the fire and the flames, and you don't even know it yet. Trading is very, very difficult, and 99% of people won't make it. It's just the cold, hard truth of this industry. It's not easy. So why am I telling you all that? Why am I telling you it's so hard? Well, here's the thing. If you're brand new, welcome. Trading's really hard, and don't let anybody tell you otherwise, because social media will try and sell you the dream very easily, very quickly. Trading is a very long and tedious and painful journey to become a profitable trader. Anybody can go long and something works out really well, or go short, but the long term, do you survive, right? Long term, not based on like 1 or 2 trades that went really well. Long term, are you making more than you're losing? Most traders will not. It's very difficult. You might have a good trade. You might have a good month. You might have a great, I'm up 3%, 5%, 10%, 15%. And then you can have one terrible, going tilt mode and you lose 20%. So just be careful out there. But the reason I'm telling you is that one of the things, this is something that, I learned the hard way multiple times. Position sizing for me was something where I thought my position sizing was small when in fact it was not. I learned that lesson many times in a row. So what I mean by that is, like, let's say your position size is X, okay? Here's your position size. Your position size is X, right? So your position size is X, and you say, this is an appropriate position size. Well, here's what happened to me in a nutshell. Position size is X, and then my drawdowns became still very large and surprised me. And I said, oh my gosh, this was not too big. So I said, fine, my new position size is sliced in half. That's got to be small enough, right? Because again, I don't want to reduce it too small. I won't make any money. Ready? That's the trick right there. We're jumping ahead, foreshadowing, if you will. I said, I don't want to reduce my position size too much because I still want to make a lot of money, right? And then I said, okay, well, fine. Clearly, this is going to blow my account. So I need to reduce my position size to get on a better track. The same thing happened again. This is the process of this is how you get humbled by the markets, okay? X went to X divided by 2, then X divided by 4, then X divided by 8. And I said, now we're starting to be a lot better. This was stupid, and I thought it wasn't. So if you are still in the process, and by the way, this was not 6 days into my trading journey. This was over the course of 2 years where I learned this lesson. So if you're anywhere under 2 years into your trading career, you may still be in the process of learning this and not even realize it, because I didn't. I said, well, I don't want to reduce my size, because if I reduce my size, like, there was this part of my brain was like, if I reduce my size, I'm not going to make a lot of money. I was still so focused on making money instead of doing what I ultimately needed to do, which I reduced it small enough where my focus went from, I want to make money, Over here, I wanted to make money. Over here, where profitability actually kicked in, I wanted to save money. I wanted to protect. Once I went defense rather than offense, my trading clicked. Position sizing was the secret weapon for me. Okay? This is a topic that I'm incredibly, incredibly passionate about because that was such a game breaker for me. Game changer. Okay? So for everybody in this room who may still be in that process and you don't even know it yet, I'm telling you, instead of doing this, and by the way, each one of these transitions was a painful learned lesson. Oh my gosh, I thought my position size was small enough. It was not. The drawdown got way too crazy. I had to reduce it. Repeated that, lost money, repeated that, lost money, repeated that, lost money, right? You can skip a lot of that nonsense by simply saying, I'm going to go minimum position sizing today, and I'm going to work the other direction, right? You could skip a lot of the pain that I went through and a lot of traders go through by simply saying, let me go, if you're trading Forex, 0.01 lots. If you're trading stocks, trade one share. If you're trading futures, trade one contract or one micro contract. I know that doesn't sound fun because you're like, well, I want to make money. I want to make a lot of money from this. How am I ever going to make a lot of money if I'm trading minimum size? I'm telling you, making some money is better than losing a lot of it trying to make a lot of it. Okay? So if anybody took that to heart, I'm telling you, you probably just saved yourself a lot of pain, suffering, and money. I'm not, what do I get? Think about this for a second. If you feel resistance to what I'm saying, if you're like, no, Nick, like if I reduce like small size, scared money, don't make no money, right? That's that mentality. I'm telling you, you can go through that route just like I did. And you can fight that idea and say, nope, I'm going to make 10, 15, 20% per month. And I thought I was going to do that too. The only time I actually got to be a profitable trader was when I absolutely humbled myself and said, I got to go small. Small saved me. Small size. And by the way, it's only small size per trade. It doesn't mean you can't scale up over time and make substantial amounts of money. I've done really well in markets over the years by playing defense rather than offense. Okay? So there's your rant for the day. I hope that helped. I hope that resonated with somebody out there. If it did, just do me a favor really quick. Drop me a yes or a 1 in the chat if that made sense. If you're going to skip the line and maybe lose a lot less money than I did first figuring this stuff out, type yes in the chat really quick. Again, that was holy crap. That was a huge, huge revelation for me. And I share it all the time on my channel because it was so life-changing to me once I realized I don't want to get rich quick. I want to stay in the game for the long term and compound this stuff, right? Trying to get rich quick means you probably are going to blow your account over and over and over. The funny part is people who try and make money quickly in markets, they consistently make themselves more broke. And people who are very patient and very conservative in their position sizing actually get rich in the markets over time. That is the key difference. That is the opposite of what social media tells you. Social media tells you, go quick, big money, Lambos that are not rented. Totally, I promise they're not rented, I swear. And try and do everything quickly and try and cheat the game. When most of those people don't even trade the markets. They just market stuff to you, courses and all that stuff through their Lamborghini, right? That's not real. Real traders scale this stuff up and they say, I've got 20 years to make a pile of money through the markets, slow, consistently, and at a pace that I'm not going to blow up doing. Gus says, say it again for the people in the back. I probably will say it again. I say it very often on my channel. That rant is something I repeat quite frequently because it's a really important lesson that really substantially helped me out in my journey. Today's the meeting, correct? Yes, it is. 2 p.m. That is 1 hour and 10 minutes. We have got, let me just double check that we have, I believe we have Alan coming on at 1:15. Is that right? 1:15. Yep. Alan's going to be joining the stream 1:15, which would be great. This gives us a little bit of time to go through some charts. and jump into some ideas. So let's just really quick take a look. I know Chris was doing this earlier if you were watching the stream, but let's just look at the Fed watch, see what the projections for today are. So it is almost a certainty that we're not going to get rate cuts today. It would be a big shocker if we did. So we're likely to keep rates where we currently are. And I would argue that that's a good thing. I would argue that we don't want rate cuts today because, although Donald Trump would love some rate cuts, we're still dealing with inflation, and the labor market gave us a good print, right? The jobs numbers added in the month of April were pretty healthy. So I feel like rushing rate cuts is not something we necessarily need to be doing. Are they still appropriate this year? I think so, because inflation's come a long way. The labor market is showing some signs of cooling off. So we do want rate cuts this year, but there is a not too hot, not too cold approach to this. And in my opinion, cutting interest rates today is not quite ready. If you're talking about between now and the next two meetings, we start to see some material weakness in the jobs report, then yes, we probably need to cut interest rates. So today is off the table. We're not cutting interest rates today. And if we do, it would be a huge shock to markets. And it would be incredibly, incredibly weak looking for Jerome Powell to cut interest rates today. It would look like he absolutely folded to Donald Trump. And again, this is not a political statement. I'm just sharing with you how that would likely look to everyone else. Donald Trump has been pushing Jerome Powell, cut interest rates, and Powell has been pushing back and, well, really just not even pushing back to Trump, but just basically been saying, we're going to do our job and we're going to cut rates when it seems right to do so. Is there some politically charged motives in there? Maybe, but I think for the most part, there is not a reason to rush rate cuts when we are still dealing with inflation and we have unknown possibilities with what could happen with the tariff situation. Look, it is not a political statement. It is not politically charged to say that tariffs will cause prices to go up. There is no question about that. Will it last significantly for like 6 months? Will it cause an inflation spiral? That's where I think that's debatable. I would lean towards no. And guess what? So does Powell. Powell has also made mention that tariffs in 2018, for example, were transitory inflationary moments, right? Now, I know people already start to roll their eyes. They say, well, yeah, Powell said he transitory in 2021 about the global pandemic. But, right, I think you have to kind of understand that the pandemic was such an enigma, such a rare, weird economic event, as opposed to 2018, which was way more kind of a normal, not normal, but an economic kind of standard environment to a degree, compared to a pandemic, which just shut the global economy down for like all of a sudden. And then there were some really weird things that popped out and broke in the economy. So I think that, the concept of inflation potentially being transitory from tariffs is a reasonable outlook. So with that in mind, do I think Powell is saying no rate cuts just to wag a finger in the face of Donald Trump? No, I think that Donald Trump might be reading it that way, but I think honestly, Powell is just saying, look, I think they could be transitory, but I don't know the effects of tariffs just yet, and nobody truly does. So let's just wait. We can afford to wait. Let's wait. Right? So I think that's a very down the middle take on what I think is happening, if I say so myself. That is honestly, I know politicians always want the Fed to cut rates. That is bipartisan. Bully the Fed chair into cutting rates because it makes the economy go burr. Right? Every politician wants that. That's not a Trump thing. That's not a Biden thing. Everybody, right? Everybody in politics, Senator Warren like pounded the table saying, Fed, you need Powell, you need to cut rates, right? They all do that. But I think Powell is likely in this upcoming, press conference I think he's likely to stick to his guns and say we're getting closer on inflation. Like, let's look at some, just real quick, some high level data. Where are we at with some economic data here in the States? Let's take a look. So, ready? Here we go. PCE is at 2.6%. PPI is at 2.7%. CPI is at 2.4%. The target is 2%. So I think it's fair to say we're not there yet. Is the direction headed in the right way? Yes, but that could be offset by tariffs. It could also be offset if you get a bounce in oil prices. It could also be, if we see a whole bunch of, we saw a little bit of, there's still evidence of the Fed's balance sheet. They're still buying a bunch of bonds. Like, there's still the potential that inflation could still be baked in, still problematic for some time. We're not at 2%. Now, we might cut interest rates if the labor market starts to freak out. But where are we at with unemployment rate? 4.2%. And a jobs report that beat by almost 50,000 jobs. So again, people get so politically charged on this stuff. They did it under Biden. They did it under Trump. People were saying the economy is terrible under Biden, or Donald Trump is going to save the economy, or inflation, Biden's going to ruin us with inflation. Like, there's always these like political headlines that you hear. But what I encourage you to do is leave that at the door and let's just look at the data. Let's look at what's coming in and let's trade based on that. Okay? If we can kind of establish that as a healthy middle ground, let's just watch the data, it will give us some clarity and help us to rule out all that noise. Okay? So check this out. Jobs data beat expectations in the last NFP report. We saw unemployment rate still at 4.2%. That's a really low unemployment rate, right? So jobs, how are jobs doing? Jobs are okay. Inflation is progressing. So we'd call this okay. So if we look at this data and we come away with the conclusion that jobs are in an okay spot and inflation is in an okay spot, do we need to cut interest rates right now? I would say no. Now, some of the trends here might be interesting to add in. Forward looking, the jobs market's showing some signs of cooling. Not terrible signs of cooling, but some signs of cooling. Look at ADP, job openings deteriorating, jobless claims are a little soft. Like, we're seeing some signs that, wage growth was a little soft. Some signs that the labor market may be cooling off. Okay. But what about inflation? Inflation is also in the right direction coming down. So why would the Fed, here's why I think, again, the Fed is likely to cut interest rates based on this trend. If those trends stay intact, inflation continues to come down, jobs data continues to cool, I think it will be appropriate to cut interest rates. But I just think that, again, let's keep an eye on the data and let's say it may not be on Trump's timeline. It's going to likely be on Powell's timeline. That is how a democracy works. The government, the president doesn't get to call Jerome Powell and say, hey, you got to cut rates today. Right? Trump is not the first president to do this, to try and pressure the chairman. That is not the first time that this is happening. This is something that politicians do. They want rates to be down. It makes the economy, it's like juking cash into everybody's pocket in the economy. Now, where does that leave us? Well, that leaves us with likely Powell is going to defend what I just described. That's my guess. I could be wrong. He could say something that, maybe is surprisingly dovish, maybe surprisingly hawkish. If Powell defends and says we are not close to a cutting rates as the market thinks, basically, the stock market's going to likely roll over, right? Because the stock market's looking forward to rate cuts, just like I just described. If the market sniffs out that we may get more rate cuts than in a shorter period of time, like let's say, for example, that Jerome Powell says tariffs are very likely to simply be a one-time price hike and not a big long-term problem to inflation, boom, that market's going to rip. That could be a new trade setup for me. If you get that stance from Powell, very dovish, market's probably going to rip higher. But what if he says instead that tariffs are a big question mark and that the way that they're being conducted poses serious inflation risk? If that's his mantra, down we go. So which one is he going to say? I don't know, right? And I'd be silly to stand up here and say, or to sit here and say that I know what Powell's going to say before he's going to say it. None of us know for certain. The market's waiting. So from a technical perspective, when we look at the NASDAQ, I like the NASDAQ to the long side and would actually be a fan of buying the NASDAQ if we actually see this move today. If we get a dump in the NASDAQ, I'd be very curious to potentially pick up some long trades. And if we see a breakout, I'd be interested in a pullback for longs there. Again, I think the path of the Fed is to cut interest rates, whether it's sooner or later. From my analysis, doesn't take me too. Again, I don't think that we need to really worry too much about how soon those rate cuts are coming, unless we had problems, right? Actually, Babu in the chat says a rate hold is good for indices, and I would say, yeah, I don't freak out about the idea if the Fed says we're going to take our time to cut interest rates. I'm kind of like, that's fine, right? I don't think we need rate cuts for this market to rebound. I think we need trade deals for this market to really rebound. You get trade deals, market's going to love it. One thing that concerns me is that the market is very much already expecting trade deals. Let me also take a second to respond to Bulent. Sorry for taking some time before getting to your comment. Bulent's a channel member. He says, on another topic, wait for the pullback. This is the second most important topic after position sizing. Waiting for price to reach a suitable level, waiting for the market structure, being patient. Bulent, that's a great point and very, very important to say. Especially, where I'm feeling right now, indices have kind of ripped higher without me. So I'm living that experience right now. Like, I'm bullish on the indices, but I've missed that explosive move higher in terms of a trade. Now, I've gone long some stocks. Like, I bought a lot of stocks in this recent sell-off, but I still have plenty of cash on the sidelines that I'd like to deploy in some long NASDAQ, long Dow Jones positioning. So if we do get some sell-off today, I'm actually a fan of getting long if we can get some retests at some levels, like you pointed out, where the market comes to us. Let's take a quick look at the gold market as well. Haven't talked about gold yet today. So gold tagging resistance here. Resistance on the daily chart, this previous all-time closing high. Remember that this is the all-time high, but this is the all-time closing high. This is where price landed right here. So we came back up to the all-time closing high. How does gold factor into all this? Well, if Powell sounds dovish, gold goes higher. If Powell sounds hawkish, gold goes lower. We don't know what he's going to say exactly, but I do think the likely standpoint is that Powell is going to hold interest rates steady. Labor data was relatively strong. Inflation data is cooling, but still has work to do. I think the Fed's likely to cut interest rates this year a couple times. And so when we look at gold, I do think that the bigger picture story is still bullish for gold. But we've had some trade deals here recently, or not trade deals, but some progress on trade deals. I think US and China are going to talk this coming weekend. Many other countries are at the table with the US. Seemingly there are deals coming. At the same time, Ukraine and US made a minerals deal. So deals are happening. And so deals to me are kind of more of a negative thing for gold than a positive thing. Standstills, standoffs, stalemates, those things are more bullish for gold. Uncertainty, right? So price action on gold looks really strong. Price action looks really, really good. But fundamentally, I don't really love gold right now. If I pull up the gold scanner on the EdgeFinder, we can see that gold is currently getting a +4 reading. Now, +5 or greater is considered a bullish setup on the EdgeFinder. So we're close to a bullish setup, but not quite. Retail sentiment is a little mixed on gold. COT is still very bullish gold. Saw a big increase in buying activity overall in recent times for gold on the COT data. So institutions making moves to the long side have been long for years, actually. If you don't know what I'm talking about, pull up the COT data. Actually, we'll do the COT data history for a second. Take a look at this, guys. Gold on a historical basis, look at this. Institutional money has been bullish for gold, has been significantly bullish gold for the last multiple years. And again, look at the price of gold in the last multiple years and ask yourself, how did institutions do with that? So everybody who was so bearish on gold during all this time, just keeping an eye on institutional money would have told you big money has been buying and holding gold for a long time. Now, recently, there has been a little bit of distribution of gold, which I do find interesting. That's shifted a little bit here recently, but still net very bullish accumulation of gold. So something to think about. When we take a look at gold's price action, is it overbought? Absolutely. Absolutely, gold is overbought. But you know what the problem is? It's been overbought for like 2 years and keeps going higher. This should be a good lesson for many traders that overbought and oversold don't mean anything when fundamentals are at play. When the fundamental trend is really strong, there is no such thing as overbought or oversold when the fundamentals are very supportive. Central banks around the world have been buying gold. We also know inflation has come down globally, causing central banks around the world to cut interest rates. These are very strong things for the price of gold. Selling gold, I know this is hindsight, but I've also, this is in my trading activity, so I'm speaking, factually about myself. There hasn't been any instances in the last few years to really get bearish on gold. I've not been bearish. I've not taken any shorts I can't even remember the last time I shorted gold. The fundamental story, I know I'm speaking with a chart that's already made a huge move, but you can go back and review all my trades. I have all my trade history on my Discord and in the videos that I do recapping my trades. No bearish setups for gold. None. Bullish, 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 bullish because of the data, right? We don't ignore that stuff. Sure, is it overbought? Absolutely. That just doesn't mean, though, that it has to come down, right? That's the fool's errand, is trying to say gold is overbought. It's got to come down now. Do you know how many dead bodies are surrounding you? I always make this this visual in my head of like gold is this big dragon and you're stepping in with your little sword and saying, I'm going to conquer gold. I'm going to call the top on gold, right? And there's countless fallen knights all around you in the room. and here comes this beastly, monstrous dragon. That's gold when people try and short it. It's like, step right up. You know, we got some snake oil to sell you. That is trying to sell gold, right? It is, again, will it change at some point? Absolutely, right? Nothing trends forever in one direction, but clearly it can do so for way longer than people think it can. Okay? Picture a dragon. You're standing in a room with countless fallen soldiers all around you who tried to take on the dragon, calling the top on gold, trying to defeat gold. It's a little bit of a fool's errand to try and think that you could beat the dragon, right? Wait for the dragon to, I don't know, for its armor to fall off or something before you try and fight it. But you're talking about a fully armored up, fire-breathing, full maturity, beast mode dragon, and she does not play around. That's what you're trying to short? You kidding me? I'm having fun with this analogy, can you tell? 100 men versus the gold dragon. See, that's not even debatable, right? With the 100 men versus the gorilla, you know, you might be able to tire it out, but a dragon, a full-blown dragon? Anyways, again, if you have your reasons for shorting gold, do your thing. I'm just telling you, there hasn't been a very good fundamentally one for a long time. And that has paid dividends to be on the long side, not the short side. Not literally, because gold doesn't pay any dividends. It doesn't offer any yield, but it's trended very well higher as a wonderful hedge to fiat currency losing a lot of value. So anyways, will it eventually roll over? Will gold eventually start looking bearish? Like, don't get me wrong. I am not saying that gold will go up like this forever. I'm just saying that the chart, wait for like a weekly. I'm talking, look for this move. Like this chart, you need to wait for, in my opinion, if you're bearish on gold, you need this chart to break. This chart has remained unbroken. It's gone upways, sideways, or upwards for years on a weekly chart. No solid lower lows, lower highs on a weekly chart in years. And guess who's just been collecting checks on this? Institutions. We've tracked it for a long time on this channel. A long time. By the way, if you don't have access to the EdgeFinder, here's a great chance to pick it up at the lowest price of the year. This discount is ending very soon. For a limited time, you can currently get access for 45% off. If you're watching with us live and you want access to our tools that we use every day, whether it be me or James or all the other hosts that were on the show today, the EdgeFinder is a wonderful tool that helps traders scan lots of market data and to stay on top of powerful trends like this. You know, the gold moves that I've made with the help of the EdgeFinder the last few years, obviously this is not a claim of income in terms of what everyone's going to be able to do with the help of the EdgeFinder. But for me personally, I have made many tens of thousands of dollars with the help of my strategy and the insights I've gained using the EdgeFinder each and every day. The right tools can excel you very far in your trading. If you don't have a copy, this is the lowest price that we do all year long, and it's ending very soon. So last call on this. If you have not picked up a copy of the EdgeFinder, send us a direct message using this link that's just been dropped in the live chat right now. Or if you're on a TV or you're watching this somewhere else where you can't grab a link really quick, just head over to a1trading.com on your phone or on your desktop, and you can chat with us using the bottom right-hand side of the screen to chat directly to our support team. Just let them know you were watching the stream and you heard you could get 45% off the EdgeFinder on the one-time price. Also, someone asked me about this overnight. They sent in a DM and they said, Nick, I want the EdgeFinder bad, but basically I can't, the dollar exchange rate is very expensive to me. Would there be any way that I could split it up into payments? And my team, the answer is yes. My team has a way to split stuff up. So if you need to split it up into 3 payments, 2 payments, whatever's easiest for you, We do offer that. All you'll need to do is ask our team about that right here. We can split that up to make it accessible to you. So even if you don't have the full amount right now, you could split it up into a couple months of payment plans so that you can get access at this low price before it ends. Okay. So where are we at? We've got 45 minutes before we get some stuff out of the Fed. And just a heads up, the way this will work is you've got the Fed funds rate, which is as almost 100% chance that we are not going to get a rate cut. So rates are going to stay the same. What matters more is the statement and the press conference. Ultimately, Powell will be taking the stand at 2:30 US Eastern. That's 1 hour and 15 minutes. That is what most likely will move the markets the most. If he says something hawkish or dovish that sends the market into an aggressive, spiral or an aggressive upside move, we will monitor that and keep an eye on it. We'll be reacting to that live, so don't go anywhere. Stick around with us. We've got another segment starting here in a second, but he is not quite on the stream yet. We're waiting for Alan to come by. Also, let me just, while we wait. So I went long. I told you guys I went long Kiwi yen. So this was a trade setup for me. Let me look at some other currency really, really quick. Euro yen, dollar yen. I don't like dollar yen. I'm going to tell you, I really don't care for that one very much on the eco front. But euro yen, I don't love the technicals on this one. Daily chart's pretty ugly. But Kiwi yen I like. On the bearish side, nothing on the bearish side. And indices, I'm waiting for pullbacks. Part of me, a small part of me, even though I'm long stocks, I would like to see markets pull back just a little bit here today so I could get some potential entries. But if I don't, I have a good list of stocks that I'm already long. All of these green flags are stocks that I own shares in. As of the recent market sell-off, I started buying shares of stock around here, continue to do so all the way through this market sell-off. And if we do go lower again, I will repeat that process. I'll buy more stocks in companies that I like for the long term. But right now, I actually think that short term, we do have upside momentum forming in these indices. And I'm looking for buys around the 5,500 level on the S&P 500. Guys, I'll be back for FOMC. But in the meantime, we're going to toss the show over for a little bit to Alan Perez. If you guys don't follow him already, he's an up-and-coming content creator / trader in the space. I love his videos. He's been doing a great job on his YouTube channel. We'll drop the link to his channel. Guys, make sure to go subscribe and check him out, especially if you enjoy this upcoming commentary from him. We'll just play a quick break. Thank our sponsors who make this show possible. If you're enjoying, hit the thumbs up button. Remember that EdgeFinder 45% off sale is ending soon. We'll drop the link to that while we play this quick break. Stay tuned. If you're someone in the United States looking for a Forex broker, it's been hard to find recently. There's been a lot of changes in the industry, so I wanted to take a moment to tell you guys about Oanda. Oanda is a US regulated brokerage that allows US traders to trade currency pairs like the euro dollar, the pound dollar, the dollar yen, Kiwi yen, all sorts of different currency pairs. So if you're interested in checking out Oanda, we're going to be dropping a link in the chat right now as we speak. They, again, are a huge brokerage in the United States that allows you to trade without the worry of whether or not your account is going to get shut down tomorrow from an offshore, unregulated, sketchy brokerage. They have been around for a long time, and I've used them myself for a number of years. So if you're looking to trade FX and you're in the US, this is the brokerage to check out in my personal opinion. So take a look at it. We'll drop the link in the chat, like I mentioned, should also be in the description of this live stream. Do your due diligence and see if it's right for you.
Hey guys, what's going on? My name is Alan Perez. For those that don't know me, thanks for the quick shout out, Nick. Hope you guys are doing good. We got a Fed day, so I'm sure a lot of new people will be tuning in because it's a very volatile event. But for the most part, right, today, I think we can all agree that Fed's going to continue, holding the rate for this meeting. There's a 97% chance. I want to get a little bit of a consensus in the chat because I know a lot of people are here. What do you guys think is going on for the next meeting? Do you guys think that, well, for one, do you guys think that Powell will be hawkish or dovish? I'm curious to know because I'm actually like in a situation where it can either go either way. Honestly, I think this meeting, a lot of the market participants are going to be looking for the actual tone and what's going to be what we can look at moving forward. So I'm curious to know what you guys think. From my opinion, just looking at the CME Fed Watch tool on Tuesday when I did my live stream with Nick here, we saw that the probability for June, I believe it was like 60 something percent, and the rate cut was like 30 something percent. Now it changed a little bit, 71. But I like to see this number after the Fed meeting to kind of see, what the overall market's thinking of. Maybe this can sway, it can increase for a hold for June, or we can actually see a little bit of an increase for a rate cut in June. So that is what I will be looking for the most part for this Fed meeting. But I'm curious to know, guys, what are you guys thinking? As far as for positioning goes, I'm pretty much the same as Tuesday. So I'm long dollar for the short term, very short term, because I do think that, markets are going to be expecting rate cuts soon, especially if we continue to get some positive data for the US. That's pretty much my basis for how I'm operating the markets. Now, there was something I wanted to go over. Guys, if I'm like super stiff with my head, I guess I'll give you a brief update on what happened. For some reason, my fiance is with me this morning. She's working from home, but I like jumped up and I landed wrong. And I think perhaps I'm operating like on a sprained neck or something. I don't know. So if I'm like super stiff, that's what it is. Hi, Ellen. I personally being hawkish on the dollar besides the rate remaining unchanged and also for tariff negotiations easing with China, but it's temporarily at least for the 90 days. Yeah, so the 90-day deferment, markets really like that. The stock market and the US dollar saw that as a good thing. And when I talked with you guys on Tuesday, I said that my main focus was pretty much that catalyst in specific, tariff negotiations, specifically with China. The market really likes that. So if I go to this screen here, I'll show you guys. Financial juice, go to market moving. This happened yesterday, right? When the Secretary Bessent to meet with China, on the 8th, which is tomorrow. Look what happened right when that came out. Dollar jumped up, stock market also jumped up. The markets are very sensitive to that news catalyst in specific with US and China. We've been seeing talks of like, India coming up, Europe, Canada supposed to be meeting this week, or I think they did already on Tuesday, yesterday. But for the most part, the biggest catalyst is with China. And we've been seeing things like them talking and, them coming into communications, not like, talking very heavily, but that it's starting to begin. In fact, if we look at here, the 7th at 9:42 a.m. Central, negotiations with China are beginning on Saturday, according to Bessent. So that's basically the premise of what I'm doing. I believe that those, good conversations are going to continue forward for a little bit. And if we do see that, then I think in the very short term, we could see dollar appreciation. That's basically what I'm banking on. That and the fact that, we could possibly hold for June rate cutting wise, and seeing what that sentiment's going to be after Fed Powell takes the stage. That's why I'm going long dollar on the short term. But I am looking for possibilities to flip. I would really like the dollar, shorting the dollar at the 101, 102 level. Now, if we get like some, if something changes then, and there's more pro dollar, or maybe the Fed's just very hawkish, then taking another stab at 103, I don't think is a bad idea at all. I wonder who's in the chat, guys. I see Vance here, but are the regulars still inside? Regular stream viewers, ball out. Bashy's been gone, I've noticed. Quang, how you doing? Quang, you're a regular. I see you all the time here. Zaza's Hub, how you doing? That's a new name, Zaza's. Where are you from, Zaza? I like to, let me ask you this. Gold update. I'll update on gold. Options, George Johnson. I don't look at options. The only thing I look for, I trade currencies mostly. I look at options expiries. So like where auction, where certain pairs are going to expire, where like there's a lot of money expiring at a certain price. I'll look at that for the most part for options, but not really. I don't trade options on the daily. Chris Pulver does that, and he's pretty good at it. Oklahoma. Max, I always see you, Dragon. Cool. These are names I've never seen before. So good to see you guys. Are you guys, George, Zaza, Tamil, Rex, or anyone else that hasn't chatted yet? Are you guys currently in positions? And what do you think is going to happen, or the tonality of the Fed? DJ Gaming, my first target would be something like the 101 handle for the US dollar. I think that's the closest level, or maybe the 105, which is basically this previous, double top, if you want to call it that, would be the first path of resistance. Now, if we continue further, I would be very interested in shorting the dollar at the 101.5 or 102. Malaysia, we have a really diverse Canada. S&P 500. Well, to Nick's point, and I think we can all agree, if the Fed is a hawk this meeting, then I could see the S&P testing at least the 5.5. The 5,500 level, I could definitely see that as a possibility if the Fed becomes a hawk. And then there, we could probably see for a more strategic way to go ahead and buy the S&P. I think the path of least resistance is bullish equities, right? As long as we keep seeing tariff negotiations coming through, I think that'll be a good play. So being patient and waiting for something like the 5,500 handle, I think would be the best bet if I'm navigating equities. Now, I know the guy in the chat, in the Discord chat, had a very strategic way of shorting the equities. He got a really good price already, and his stop. And I think he mentioned in the chat that he was, very possibly he's willing to go ahead and take the loss if the Fed is dovish, which is something I really think is very important, is making sure your sizing is accounting for the worst case scenario. I think that is a possibility, but longer term, I would like to buy the 5,500 handle. Gold, what's your analysis? Okay, chat's picking up here, guys. Thank you for that. Best ticker to buy gold and silver on Robinhood. George, I think going the ETF route would be the best bet. You can trade it by the ticker GLD. Finally having a good month after such a long time of drawdown. Quan, I applaud you for that, for being persistent and going through it. Everyone has those moments. I myself had that moment as well last year. So I congratulate you for sticking through it. Vance, it seems like you're one of the outliers for the gold trade. I don't think so. I think it's possible that gold can go down. Now will it go down forever? It's not one. It's one of the things like the NASDAQ or the S&P where over a long period of time it goes ahead and trends higher. But I don't think you're an outlier in shorting gold. I think a lot of people are on that boat with you. Andre, I agree 100%. I think even the 132 would be a good level, but 131 would be even better if dollar gets some strength. And if we look at out of all the currencies, this is interesting, right? There's one that stands out in particular. Let's go to, where is the new scanner? Give me a second. Eco surprise meter. Out of all of them, look at the pound. Cielo, you can't really see it. I hope you can. That surprise is a really high number. I think the pound and New Zealand are one of these stronger pairs. So when it is time to go ahead and go long or go short the dollar, pound and New Zealand will be on my radar. And Andre, if we do get that level, that 131, I think that'll be a good spot for sure. Representing South Africa. What time is it for you guys in South Africa? If one of you guys can share. So yeah, SLV. Thank you, Chandler, for typing that. Yeah, short term, right? If we get a hawkish Fed and some continuation in trade optimism and things of that nature, we could see those safe havens like the yen, the Swiss, gold and silver. Gold go ahead and take a little dip, which could be a good buy. If gold takes a bigger dip, right? Maybe we retest this level. It seems like, let me clean this chart up for you guys, just so we can get a fresh pair of eyes. It seems like this level here, right? 1, 2 right here. Seems like this could be a really good level if we were to retest to possibly buy in. Now, if we keep flopping and go a little bit lower, then I look for something like this for a bigger retracement. I think this will be the first level. This could be the second level. 630 Nigeria. Cool. Montreal, Canada. So you guys in South Africa, you guys are staying up for the Fed. You guys have some, what's the word? You guys are committed. Yeah, gold greed and fear index now at extreme greed. Yeah, I mean, we came up here with some force, right? Overnight, over the 2-day period. And now we're seeing a little fade. I like to see how this candle closes. Perhaps we can, perhaps another possibility, guys. I didn't say this, but maybe gold just kind of hangs out like this for a little bit. You never know. Scotland, that's a beautiful country. So do you guys, other people in the chat, are you guys positioned in one way? I'm just curious. Someone asked for my opinion. I believe it was on dollar Swiss or dollar yen. Both similar. Okay, it's 1930 this side, Alan. Cool. Trading from Italy. I've always wanted to go there. New Zealand, US dollar. Yeah. So if I'm going to go short dollar, whenever I do go short dollar, to your point, Zaza, and the person that, Andre, it was Andre that said pound dollar. If I were to buy New Zealand dollar or the pound dollar, because at the moment, those are the ones that are showing some really good prints as far as their economic data, I would look for something like this on the New Zealand. A first attempt would be there. Second attempt, I don't know, this cluster right here draws my attention. That's something I would look. But I understand this one's a little far out. For the pound, I agree with Andre a lot that this 132 to 131 handle would be a very good entry point where you can anticipate a leg higher, and then we can just target these recent highs here. It seems like this level at the top at the 134.2 is a point of resistance. Now for longing the dollar yen and dollar Swiss, those are, the yen and the Swiss are both safe havens. One thing I've been doing is going long, short term. So, perhaps we get to the 148 handle. That would be my area where I would try to go ahead and short dollar yen or the 151. But I bought the dollar yen right here at this level, and that's why I'm holding it. Actually came down a couple hundred pips. But now it seems like we're coming back higher. And this one was a very short and very what I mean by short is very low position sizing for me, like extremely short. So I bought in at this level. I'm just letting it do what it has to do. If I get stopped out at break even, then that's fine. Ghana and Thailand. Wow. New Zealand. Pretty diverse audience. You guys are very committed, I'll say that. You're long dollar Swiss, Jude, right there with you for the short term at least. Now, for trade management purposes, let's say we get a dovish Fed. Then if I hear that rhetoric through Powell today and we see that the CME Fed Watch tool is shifting from a 71% chance of cutting in June and it starts dropping to the 60s or whatever, and we start seeing that flip, then I will go ahead and manually close out those trades. UK, Morocco, geez. I heard Morocco is very beautiful off main. It's good. I see that you're a regular as well. I always see you talking, so it's good to know where you guys are coming from. Dragon, I was thinking that in my head. Honestly, I was going to ask you, but I don't want to get off topic. I was going to say, if I were to go to Italy, what part of Italy that's, not that chaotic or saturated with tourists, and what time to go. So it's good to know that now is a good time. Now, is it just, the springtime, or when would be a better time to visit Italy? I've always wanted to go. Gold, I think that today consolidation, tomorrow push up, Asia will start. Perhaps, with gold, it's appreciated a ton, as we know that. I think it can go either way. I think we can just range trade in this position, or if we do start to roll over, we can go ahead and start dropping, maybe, like I said, buy at the start 200 handle, or we could start rolling over even further and buying at the 29.50. Until the Pope gets chosen, of course. Okay. Now, my positioning, guys, you guys know my positioning for the short term. Is there anything specific, charts or any trades that you would like for me to review? Maybe your trades or chart setups that you guys are interested in my opinion, or maybe we can just dissect some things together, possibilities. Max, for now, you think is a good visit? GJ? The interesting thing about the yen was very, and look, we're approaching this level, or we were at this level. Yen, I was very hawkish on the yen. They were actively trying to raise rates, but now they're, the prints on the yen side have been missing expectations, and so I think Nick is long New Zealand yen. I think that's correct. Pound, we know the pound's very strong in the moment, so perhaps, right, if we get short-term dollar strength, we could wait for the pound to get to a level like this, like the 190, 189 area, 188. And then maybe we can get a better opportunity to go long dollar yen. Now, you could go ahead and, I don't know, place a market order now with very small sizing, with the expectation and the wiggle room to say, look, we could go ahead and get here or a little bit lower. But pound yen, I think, would be a good buy. for beach later after June. ETH, gold. Okay, gold. The best time would be probably during autumn since people go back. All right, I'm seeing a lot of new people in the chat, so thank you guys for responding. I always want to make sure we keep engaged audience. Also helps myself, continue the conversation and not let it dry up. As much overextended as gold is right now, I think it can go higher knowing gold. You never know. Reverie, that's the thing about gold, right? Is that, for example, similar, not as extreme, but similar price action right over here. Look, let's dissect this. Right here, you could say double top, right? Here, you could say similar situation, or even here, but let's just go right here. You could say double top, something like that, right? And then what happened is we kept chugging even higher, and we went a lot higher than what we thought. And market consensus at the time was like gold's at all-time highs. Everyone was pretty much focused on the 3,000 handle because right here we were at the 2950, and we're like, is gold going to hit 3,000? Gold's going to hit 3,000. And then where are we now? We're almost, we pretty much approached the 30. Well, we did approach the 3,500 handle. We went up 18%, almost 19% off of that. So that's the cool thing about gold is what may seem like the top now could be, in 5 years from now, or a year now, or even weeks from now in this environment, could be just like the median. But I think right now, the biggest focus would be on the tone of the Fed. Carlos Amaya, greetings from El Salvador. My dad's from El Salvador, and his name's also Carlos. Cool. Max says gold will do the usual FOMC move, up, then down, then choosing a direction. Yeah. What happens in these really volatile events is if there is a surprise, then what market expects, then in real time, you'll see a lot of repositioning. And so that's what you'll see, these big wicks and big moves, both directions. And then ultimately you get the move right after that. I'll check on dollar yen for you, of course. Dollar yen, I bought at this level here. We held it once, twice, ended up being 3 times. And now I'm targeting. I want to see what happens when we get back to this 145. If we start rejecting the 145 again, then I'm going to say this could be a good level of resistance, probably take profits. But ultimately, I want to see it try the 148 or the 150 handle to go ahead and get the best possible short price and then short dollar yen there. But if I'm going short the dollar, I think the dollar yen would not be my vehicle of choice. I think I'd probably buy the pound or the New Zealand dollar because you have to pay the swap on the dollar yen. EU. EU is in this range. If you just look at the dollar index, it's going to be pretty similar to what the EU is doing. Indecision is what I see. Just hanging out here. I want to see confirmation one way or the other. But for now, we're just kind of hanging out in there. What I would like to do is see the EU drop and maybe hit the 112, the 111.5, or even the 110 to go ahead and look for buys on the EU. Francis, no, I'm not going to trade the gold. I don't trade gold actively. Like that's not one of the things I trade as far as for my trading. But I also wouldn't, if I were to be trading gold, I wouldn't just because it's like in this really indecision range right now, in my opinion. So, Scott, that was your similar thought. Yeah. New Zealand yen, I think, is a trade that Nick called out. So if you guys are in it with him, awesome. I think the yen went from a very, very hawkish stance or a very bullish asset to it's now starting to fade a little bit. And the New Zealand and the pound are very, very strong. So I think New Zealand yen would be a good buy opportunity. Edgar, yes. Remember the Fed, if rates pause, that will be bearish for the news for some pairs and bullish for some pairs as well. Yeah, it'll affect, risk on currencies one way, risk off currencies separate way. I definitely agree with you there.
What's up, Alan?
What's going on? How you doing?
Pretty good, man. I've been listening to your commentary. Your live stream skills have gotten very good, very fast.
You think so?
Yeah, man, they've come a long way. Like you engage the audience well. I'm like, dang, I'm taking notes. I got to figure out how to be better with the chat like you. That's awesome.
Oh man, you should see how I feel inside when the chat goes dead. That's why I try to keep some people engaged. But it's really cool. You have a really diverse audience. I saw Morocco, Europe nations, Canada, like everywhere. South Africa. That's pretty cool what you've guys done.
We do. I mean, that is one of the coolest things is this community is so diverse, not only in, places that people are from, but also like skill levels and styles of trading and what styles or strategies people use. There's all sorts of time frames, some scalpers out there, day traders. It's cool. I mean, that's kind of the dream component of this stream is we have people from all over the world, contributors like yourself, myself, and the rest of the gang that kind of come on here and just share some insights with people. And it's a lot of fun. I'm glad you're a part of it, Alan. We've enjoyed your segments a lot.
Well, I appreciate you guys having me. And someone says this is the best community. I agree 100%. I think that's why a lot of us stick around.
Yeah, and Alan, I mean, I know you've talked about this before too, but this stuff. I know we're all kind of like in the internet, but I've actually met Alan in person, and I've met a lot of traders. In fact, on Friday, I'm meeting up with another trader from YouTube, Wayne McDonald. Some of you guys might know him. He's been around on YouTube for some time. I'm meeting up with him on Friday for lunch. So, I mean, there are real ways to meet people through this stuff too. So I know, trading can be lonely, but it is a real way to meet like-minded people. And we all know anybody who's done this long enough knows just how hard it is to reach that profitability. So typically people who are like crazy enough to stick with this stuff, they get along pretty well.
Yeah, you guys, the cool thing is once you get to that stage, you guys share a lot of the growing pains together. And so there's a lot of look, if anyone goes through the emotional pains or whatever, going through pains through it, you can appreciate someone's experience going through that as well. And I think when you can relate to a lot of those hard aspects of life, you can build some cool relationships for sure.
Yeah. No, it's true. Well, Alan, thank you very much for joining the stream, adding some commentary to the mix here today. And with that said, we appreciate you coming on. For everybody who enjoyed Alan's commentary, guys, do us a big favor. Go find him on YouTube. It's at Aspire Trading Co. You can find him there, or you can click the link that's been dropped in the chat to find him as well. Or you can also search up his name, Alan Perez Forex, and you'll find him on YouTube as well. Alan, thanks very much for coming on today, man.
Thanks, guys. You have a blessed one. Hi, Ivan. And the Net Grinders, he's the same height as me, if you were wondering. But you guys have a blessed one. And trade safely, please.
All right. See you, Alan.
All right. Bye-bye.
Good stuff. All right. So closing in now on what we've got ahead. We've got, of course, the FOMC event. The press conference is ultimately what will largely be the market mover here today. We are unexpected or not expecting to get an interest rate cut. We discussed this earlier at length. Basically, probabilities are nil for a rate cut today. We're not going to get a rate cut. And if we do, it'd be a huge shocker to the market. Most likely, however, we will get some clues as to how possible a rate cut in June or July is likely to be. Most likely today, we are not going to get a rate cut. It is all about the future projected moves And the way we're going to get some of those future projections is from commentary from Jerome Powell. That's why the press conference is what gets the market to move so much. That's why you see that meme where Jerome Powell steps up to the microphone and he says, "Good afternoon," and the market goes crazy. That is a real thing. And, obviously we'll have to see what he says today to give us any clues on that. But yeah, definitely keep an eye on that. We will be here for that event. Roy says, there's still any discounts in the A1 trading tool. You are catching the very tail end of it. It is ending in, what's today, Wednesday? 2 days. 2 days left. We extended it by a few days for people who were waiting to, or who needed a couple extra days to get access to the tool. If you don't have the EdgeFinder, everything in our store, VIP memberships, EdgeFinder, Stockbox, our TradingView indicators, our MetaTrader indicators, everything we've ever built is currently 45% off. If you need information, go to a1trading.com, or the easiest way to get access to those discounts is to send us a direct message here, and our support team can help you out. So don't miss that opportunity. If you're someone who's like, oh, I've been waiting for a chance to pick up the EdgeFinder, I'm telling you, this is the price right now. EdgeFinder's gone up in price over time. It's had a huge dip right now, and it is guaranteed to go back up in price at the end of this week. So don't miss it. Okay, so general outlook for me today. So I did go long Kiwi Yen. I heard Alan talking a little bit about my trade there. So I am long NZD JPY. So if we pull up this one, I am long NZD JPY around current levels. We'll see if this trade goes well. If it goes against me, I would like to add to the trade around 84.50. So if it goes lower, I'll get a chance to add into my trade. And if it goes higher, we'll look to take profits. I'm looking for a move back up to like 87 plus. Buy the dip on the EdgeFinder. Exactly. Ballout says EdgeFinder is the real deal. Appreciate that, Ballout. That's the thing is the EdgeFinder it's just a tool. And somebody asked me, Nick, is the EdgeFinder going to make me a profitable trader? No, it's not going to. Is TradingView going to make you a profitable trader? No, like these are tools. These are resources that can certainly help you in the process of becoming a better trader, but they won't do all the work for you. And I would never promise the world like that to anybody. It's kind of in the name. It helps find an edge. It doesn't do the entire workload for you, right? So just something to think about. Pakistan and India are going to war. Do you think this could affect the prices of gold? That's a good question. Gold prices shot up in the last few days here. Potentially a little bit of that coming from that part of the world. I know developments were occurring in the last 48 hours or so. So we'll see. I don't really know enough about that circumstance. I can't really comment on it extensively. I just know that there's been, for quite some time, disagreements in the region, and there's been recently some escalation on that front. Anytime you do get war escalations, that does typically have a positive impact on the price of gold, but it depends, of course, how it goes from there. Like if we see further escalations, more nations getting involved, stepping in, further advancements in the war worsening basically would be bullish for gold, and negotiations and compromises would be bearish for gold. Same thing with Ukraine and Russia. Same thing with Taiwan, China. Generally speaking, more war, gold goes up. Less war, gold goes down. Most of the time, that's pretty much how it works. But it all depends about where we go from here. Because you might say, well, we have war, so shouldn't it go up? Well, yes, but the market already did go up. We need further developments for price to go up more if gold is going to move extensively off of that catalyst, right? So when we look at gold, as we go into this let's do some kind of hot spots, if you will. Let's do some hot spots in terms of price levels and things that we're watching. Gold around 34.40. You got huge levels of resistance here. If you're a bull on gold, I'd say let's look for a confident break above, and a closure, an all-time closing high would be a really positive signal for gold. Now, obviously, that would mean, we see something like this. So price has already gone up. But if that were to occur, what would be my view? Well, from a price action only, not considering, the rest of my bias, price action would be very bullish, likely would continue to kind of just churn higher on that momentum. Right? Nick, how often do you have a chill day? Lately, literally never. I need some more chill days, but lately it's been hectic. We've got 2 interns joining us this summer at the office, which basically equates to mapping out projects for them, and software engineering side of things at A1 has been really, really hectic, and trying to improve the content game, trying to get back on Instagram. It's been a grind, man. And I love it. I love that side of my work. I do, obviously social media, and I do trading. But man, it's been hectic. How was your vacation? It was a mini vacation. I was gone for a weekend for a wedding. We were on the beach for a couple hours. That was really nice. And I still think about it. In my head, I'm pretending I'm on the beach with my feet in the sand. Anyways, key levels, right? So gold, watch how we react today. I think you actually have a really good, you had 2 decisive days. You have a really big level of resistance here. If bulls take it, if we close above, I think all's clear for further upside in the short run for gold. That would be my price action basis for gold. If you get rejection, so if we close lower than we are currently, like let's say you get this close today, likely that would mean gold maybe is solidifying that we're in this range and would probably make a move. I would not be surprised if we saw in that case a move back down to 3,200. So watch the candle close today on the daily chart for gold. I think that's a big tell of where we're likely headed in the short run, in my personal view. Bitcoin, just a quick look here. I like Bitcoin on the long side. Would love to see this thing kind of come down a little bit. I actually would probably take a stab on the long side if we hit 94,000 again. In the short run, I'm getting confirmation from the EdgeFinder. It's one of our top setups at this time. Bitcoin +7 score. I really like it there. So looking for a pullback there. S&P 500, 5,500. I heard this being talked about by Alan earlier. Very easy setup for me. And when I say easy, I don't mean that's a guarantee of profit. We never know. But in terms of easy, I think it's a straightforward setup. Huge break above that 90-day pause announcement day resistance right there. We come back into that area. I'm looking for long side continuations on this chart. NASDAQ, same kind of concept. 19,200 is a level that I'm watching. 90-day pause day resistance could now act as support once more. Watching for that kind of move with a bullish bias on indices. If you ever need a sales guy to move EdgeFinders, let me know. I need a job. Tiger, we've got 3 wonderful people currently on the sales side at A1 that just help with customer support and closing sales for EdgeFinder. If you are interested in that in the future, we will always make those posts public. We do like to try and source our talent within the community. So keep an eye out. Okay, so let's see what else. Dow Jones, 40,800 kind of looks interesting. I missed my entry on this one yesterday, but I also was a little hesitant with just such a minor pullback right ahead of an FOMC event. So I'm going to watch. I do really like the Dow. Look at the Dow relative strength here, guys. Relative strength for the Dow Jones looks really strong today, up 0.7% on a day where, NAS is red. It's good outperformance. Russell looks okay. Would like to see Russell either down to this area here or break and retest in this area here. So Russell's on the watch list, but not quite ready. Is the DAX on the list? Look at the DAX, guys. You want to talk about relative strength? Look at the DAX. The DAX is back to all-time highs. Very, very impressive. This makes me want to be a buyer as it is leading the pack when it comes to indices. And I'd like to get some of the action, if you will, on the top performing the index right now level. We've got, DAX, and I think Chinese stocks are also doing pretty well. Here's HK50. So you're getting some relative strength that looks actually stronger for international stocks. So there are some other ideas that I'm looking to play if I can get them. On the currency front, some yen crosses. I told you already I'm long NZD JPY. Any updates, new changes, or trades that I take will be shared with inside of our Discord community. We do have a free version and a paid version. So really quick, if you're not in our Telegram channel, real quick, we'll drop the link to our free Telegram channel where we share analysis each and every day for free. And if you'd like to sign up for the VIP signals to see trades that I'm taking, like I'm long euro, I'm long Kiwi yen. I traded gold here recently, just closed out of that one. All of the trades that I'm taking get shared as notifications within the VIP group. If you're not in the Discord and would like to be, head over to a1trading.com/VIP or chat with us on the using the link in the description. Okay, guys, we've got just about 15 seconds to go here. We can go ahead and roll our breaking news here. So like I said, federal funds rate, very, very unlikely to come in. Yes, so there it is. So 4.5% as expected. And now we'll watch to see if anything substantial happens on market movement side of things. Let's just switch over. Usually you don't get a big move on this first part. Usually the release of the Fed funds rate and the FOMC statement does not usually get a huge move. It is usually the press conference 30 minutes later that has the potential to substantially move the markets. If anybody comes across some interesting headlines and would like to share in the chat, please do so. Also, real quick, if you haven't already, make sure to hit the thumbs up button on the stream. Nick, does the EdgeFinder license expire at some point? CG, no. So we do offer one-time payments for the EdgeFinder. So you don't pay every month or you don't pay every year. You pay once and you get access. You don't have to pay again. We continue to support and maintain the product. You pay once. Okay, let me just see what we've got. Just reading some headlines here. Give me just a second. So again, we kept interest rates unchanged as expected. Committee judges risks of higher unemployment and higher inflation have risen. Higher unemployment and higher inflation have risen. Economic activity has continued to expand at a solid pace despite swings in net exports affecting the data. Unemployment rate has stabilized at a low level. Labor market conditions remain solid. So far, really no big moves here. Slight higher in gold, slight move higher in stocks, but for the most part, everything relatively unchanged. Oil prices, look at oil prices today, down 1.3%. I do think from a longer term perspective, I'm going to probably buy some more oil and gas stocks at some point. I own some ExxonMobil and I would like to own a little bit more. Inflation remains somewhat elevated. Committee judges risks of higher unemployment and higher inflation have risen. Conference starts in the press conference starts in about 30 minutes. Interesting. So like I said, overall market reaction here has been pretty muted so far, where likely, and that's pretty much to be expected, likely the groundbreaking stuff, if there's going to be any of it, is going to occur during the press conference. Let's see what else we've got. Nick, do you ever trade the news? I do not. Not in, well, it depends what you define as that. If you're talking about like dropping down to the 1 minute chart, whipping out my tokens and my casino chips and throwing them at the machine, no, I don't do that. I don't trade the spike or the release of the news because again, the release of the news can be so spready and like your broker will widen spreads dramatically and movements can be so sporadic in one direction than the other, like half a second later. You have to be really careful with doing that. Instead, what I do is I don't try and compete with the, instantaneous algorithms in the system. Like I'm not going to try and fight those. However, do I read into what's happening and try and make an educated guess on where markets are likely to move based on the fundamental impacts of stuff? Yeah, definitely. So I do trade news, absolutely. I just don't like scalp news, if that's what you're referring to. Nick, you said you want to hold oil stocks, but isn't it becoming an obsolete industry? That's a good question that I've thought about since I started trading back in like 2016. Oil, however, during that time, even though alternatives have increased in terms of their production of energy in the world, oil and gas have massively increased in that same period of time. So here's the thing, right? People sometimes think like oil is going to someday just tank to zero because it'll no longer be needed. But what's actually happening is here's oil's need, right? Going up and up and up. Look at this. There goes S&P a little bit lower. Alternatives are also rising, but they can actually both rise at the same time. It's going to be a very, very long time before oil can be completely replaced by alternative fuel sources. Very long time. Because the demand of of energy in the world is so massive. So no, I have no problem with a long-term, bullish position on oil stocks that I think have potential. S&P 500 moving a little bit lower here now. Went green to red now. Down as NASDAQ's down 0.5% here. Again, I wouldn't freak out too much about that move because it hasn't really, this is noise ahead of the event, in my opinion. Okay. Yeah, no problem. No, I thought that was an interesting thing too. What's interesting, right, about like oil is oil production. Like, will oil be obsolete anytime soon? Like, the thing is, what is going to replace the massive demand for energy that oil currently fills? Is it going to be wind? Is it going to be solar? Is it going to be nuclear? I mean, nuclear is probably the best candidate, but in terms of do people want to allow nuclear power to be massively produced? That's gets people all up in arms. So there's nothing that's like a real easy solution to just saying, oh yeah, we need ginormous amounts of energy. Where are we going to get it outside of fossil fuels to fill that void that can be achieved at a reasonable cost, right? The most likely candidate would be nuclear, but the problem with nuclear is that people hate it. People don't want, I think nuclear power is a really cool concept, but many people have heard of like Chernobyl, and there's like horror stories of what can happen to regions, and there's negatives for nuclear. Obviously there's negatives with fossil fuels as well. But the point is, there's not like an obvious like the demand for energy is only skyrocketing more and more every year, especially with like AI, right? The demand for power is rising and rising and rising. So the demand for oil is still always going to be there, in my view, for many, many decades. NASDAQ pulling back. I would love it to give me just double that move, and I'm probably going to take a long trade. Natural gas. So, I mean, the point is, though, that just makes me, so when you see oil prices, like take a look at oil prices on the weekly chart. $58 oil. This is what you have to ask yourself. Okay. Do you think that we are going into a recession? If the answer is yes, oil is not a buy. But if you think that the global market is not going to go into a recession, in my opinion, oil prices are a buy. So I lean towards that direction. I don't think we're going to go into a massive global horrible recession. At least I don't see the evidence of that at this time. So that makes me think that likely oil prices, especially now that we're in the 50s, are starting to become an attractive longer term buy the dip opportunity. So I express my long positioning through a stock, ExxonMobil. And if we do continue to push lower in oil prices, there is a positive correlation for the most part between ExxonMobil, the company, and crude oil. And so from a long-term perspective, if we go down and test like 96, that sort of area on ExxonMobil, I will definitely be personally building more of a position in my long-term ExxonMobil positioning. So that's how I would play that. Wasn't oil elevated in 2008? Well, remember that 2008. Well, the thing is, right? 2008. Let's go take a look at that. 2008, prior to kind of everything crumbling, right? Stock market sold off. The economy lags the economy once, or the stock market leads the economy, right? So stock market crashes, and then the economy and oil prices absolutely plummeted down to $36, $40 a barrel, right? So again, something to think about. Oil is a really interesting conversation. It's a fascinating, it's the most important commodity in the world if you think about it. Where is oil on the EdgeFinder? EdgeFinder is given a +4. What is holding back our score on oil prices? Because now I'm feeling really bullish just having that conversation. But I won't take a trade unless, what's going on with our filter here? Is there some kind of maintenance we're doing, or is that actually just need to be reloaded? We'll see. Sometimes the EdgeFinder just needs to be reloaded. Like sometimes locally it just needs to be reloaded. And there it is. So it's working fine. It just needed to be reloaded. Okay, so if I go commodities here, let's take a look at oil prices together just for a second. And I'm going to show you why I am very curious if oil prices get a little bit of a price action reversal. Like I'm long oil. Like I'll tell you that is a setup waiting to happen for me. Oil is currently getting a neutral reading, but it's a +4. So for new viewers who have not been here before, I base my trading not just off technical analysis, as you can probably figure out by now. I'm not just a technical trader. I also incorporate sentiment analysis, like what the crowd feels like and what institutional money is buying and selling. And I also look at economic data. Economic data has been surprisingly upbeat. Manufacturing PMIs, services PMIs, retail sales numbers, employment data from NFP recently. These numbers have been relatively strong compared to forecasts. We also see institutional money accumulating oil. So I have a bullish bias on oil personally, but what we're missing here, where we're getting negative score, is the trend within the EdgeFinder, which it does consider trend, is not super attractive for oil prices. So if I pull up oil here, right? Oil's down 1.9%. Take a look at the daily chart. This is not a chart that I want to buy based on short-term technicals. What would I need to see bullishness in oil? Well, at the very least, take a look at the 4-hour chart. We had a nice push. We gapped lower, filled the gap on oil, shot up to this level of resistance, failed, and went lower. If we get some sort of higher low and we break through that level, the EdgeFinder will probably flip bullish on oil, and that would probably be a setup for me. So I really like the prospect of getting long oil if price action starts to cooperate. Right now, I would say that the price is simply, sellers are in such control of this market. Look at what's happening. Look at what's happening here, right? You're getting these huge flushes lower. You're getting gaps down. Gaps get filled, and then market rolls over again. And then these big short-term pops that you're getting are being met with a lot of sell pressure. So I'd like to see the behavior of this chart change a little bit before trying to time a long trade. So again, back to the daily chart, we have resistance, local short-term resistance here, bigger resistance here. So from a daily chart perspective, I'd be willing to take a long on oil if you get this kind of move. Because what's likely going to happen is, like I said, most of our indications within the EdgeFinder are bullish. The thing that's missing is that the trend is still reading bearish. And I'm glad that it has been, because this has not been a chart that I'd want to be long in recent times. The EdgeFinder's kept me out of that trade, but I am bullish on oil, just waiting for the price action to agree with the fundamental analysis. Does that make sense? Trend reading of the EdgeFinder, how is it calculated? Great question. So first of all, let me show you. So if you have more questions, you know where to go. If you want to know how we score things and how our system computes different calculations, head over to a1trading.com, go to under EdgeFinder, click tutorials. And I'm going to drop this link for everybody in the chat that would like to bookmark this and explore this on your own time. Head over to what you're looking for is, where is it? Do we have that on here? Price forecast. There we go. Price forecast calculation. So go price forecast, forecast calculation. And I'd actually like to change this tab to trend. So I'm going to mark that as a to-do for me really quick. Price forecast, change to trend. So yeah, you can read all about how we score everything within the EdgeFinder on this page. Also, just a heads up while you're on the page, click this message right here to chat with our support team. Let them know if you're interested in the EdgeFinder, the 45% off sale is ending very soon, as in Friday. So if you have not picked up a copy of the EdgeFinder at 45% off, send us a direct message using this link right here that's been dropped in the chat, or on our website, just click this chat icon in the bottom right hand of your screen. Okay, so we've got the press conference starting in about 10 minutes to go. I do really like this oil trade, guys. I'm going to watch that one close. And if I take that trade, I'll let you guys know inside of the Discord. But I would like to see at least something like this. Like I'd like to start seeing some higher lows. Would be much more interesting. But most of our indications look okay for oil. So I'll keep an eye on it. Do pound dollar? Surely. We'll take a look at pound US dollar. +6 on the EdgeFinder. So I do like this chart quite a bit, and we did establish some pretty good support here. So I am bullish on the pound. So here's a couple levels that I like. I like the pound at 1.3250, but I like it more at the 50% retracement around 1.31. So this is how I personally would approach the pound dollar. Possibly a long position here at 1.3250. And I would add to the trade at 1.31. But I use a dollar cost averaging approach when it comes to Forex. So when I'm trading currency pairs, I typically accumulate in waves. So I don't go all in right here with a tight stop. I don't do that on currencies. Currencies have a tendency to chop a lot. So I'm typically looking for more like, okay, I'll take a stab here and I would add to the trade if it came here, and maybe a third trade if it came here, and I would look for a overall push higher. So I enter in pieces when it comes to Forex. Nick, did you take a trade on gold? No, Eric, no trades on gold for me right now. EdgeFinder is giving it a neutral reading. No interest on gold for me personally. It's moving great, just not really, not meeting my personal criteria for trades. Let me take a sip of water. Hold on. Hey, Antonio, I did actually take a trade on NZD-JPY already. Talked about this a little bit earlier. So I went long NZD-JPY. To your point, it is a bullish setup on the EdgeFinder right now. I mapped out the full trade in the Discord group. If you're not in the Discord group, I would encourage you to do so. I know a lot of EdgeFinder users join us in the Discord, but not everybody does. If you'd like to get access to the Discord, that is something that we offer at a discounted rate to existing EdgeFinder members. So if you have a copy of the EdgeFinder and you are not in the group, you can trade alongside us as well. Myself, Frank, Ivan, we're sharing our trades in here. So if you're not in there and would like to be, send us a message, first link in the description, or chat with us on our website, a1trading.com. Just ask, let us know that you're an EdgeFinder user and you'd like to get access to the Discord. So I do like Kiwi Yen quite a bit. Talked about it earlier. I like the pound to the long side. I'm already long the euro. I don't think euro still has, does it? Euro does. Euro does have a bullish reading on the EdgeFinder as well. So I'm long euro. I'm long pound. And I'm also long CAD Swiss. I've been stuck in a CAD Swiss trade for like 3 weeks now. CAD Swiss is now, and it's now even gone red. So I don't love that trade. I'm just working with a trade that's gone against me on CAD Swiss. So this is an example of a dollar cost averaging situation where I'm long this currency pair at 2 different levels, both in the red, and just kind of looking to get out of the trade. So in just a few minutes, guys, we've got Powell on standby. We will be bringing it up on the stream. And once we have that feed, we'll put it up on the screen for us to watch what he has to say. He will be coming out. Big thing to watch out for. Tariff conversations. Anything to do with inflation expectations. Anything to do with labor market expectations. These things are likely to move the market quite a bit. Hey, Nick, how do you think the Fed announcement today could impact gold in the short and in the long term? So in the long term, I do still think gold prices are riding higher on the prospect of rate cuts this year. However, that's been the story for a while. So gold already has been moving up off of rate cut expectations. And I do think that it's likely to continue to be a boost to gold prices. But I think that recently we've had some signs of better than expected economic data out of the United States. It's not great, but it's not all horrible either. And so we're probably not going to get rapid, massive rate cuts. We are also likely to get trade deals in coming weeks. We are also likely to see Ukraine and Russia eventually close that down. Let's hope, right? For the good of the people in those places. And all those things to me are headwinds to the price of gold. So personally, gold's momentum is really impressive and I would not short it. But I think that for me personally, when looking at my system, my interest is more optimistic than wanting to get super bullish on gold at all-time highs. What I mean by that is optimistic in the sense that I think trade deals are coming. I think rate cuts are coming, but they're not going to be emergency rate cuts. I think they're going to be slow and steady rate cuts. And all of this leans my bias as reflected in the EdgeFinder's automation of what I just described, bullish indices, NASDAQ, Dow Jones, even foreign stocks like, the UK stock market or the DAX. Like, I like these things a lot more personally right now at this time than trading gold long. And again, we've played gold this year quite a bit. Like, gold was my best trade of the year by a long shot this year. So I'm not saying, trade's dead, it can't keep going. I just think that it's all about, you have a certain amount of capital to deploy in your trading account. And I was very correct in the first portion of this year to dedicate a lot of that capital into gold, right? So as a portfolio manager, you have options, right? You have options of where you want to allocate your funds. If you trade, especially like I do with a stock brokerage, like I can put capital, I could put it in gold, I could put it in stocks, I could put it in bonds, I could just keep it in cash. And for the first chunk of this year, I didn't play things perfectly. So I'm not going to try and come on here and say I'm up $50 million this year or anything crazy like that. Like, I didn't play this year perfectly, but I did have capital oriented towards gold and towards stocks. So this year, while the stock market has done poorly, and I did not make a ton of money off stocks this year, I made quite a bit of money being long gold. However, I've shifted my positioning here recently. I wiped away the gold trade. And now I'm in this dynamic. I'm long stocks, and I'm sitting in some cash waiting for pullbacks to actually transition more into stocks. So that's my positioning at this moment, explained in a super simplified manner. I'm very bullish on indices. I've been accumulating stocks, looking to buy the indices. And again, the reason I'm saying that is not because I'm feeling a hunch. It's because my system told me to be long gold in the first part of this year. I built a trade plan around that. I executed. I was long gold. Conditions have changed. I have to adapt. I can't be a permanently long gold or permanently short something or permanently. I'm a trader, right? So I'm adjusting to what my system is telling me and then looking for proper positioning. So I'm looking at Bitcoin differently. I'm looking at the S&P 500. I'm looking at NASDAQ, and I want to be long these things. Now, just because I get a reading does not mean I go full port long the Dow Jones today at this second, right? But I am looking for trades on those things. So like Dow Jones, I like this one, but I like NASDAQ quite a bit more. NASDAQ, the technicals look really good. If you give me a pullback to 19,020 or 200, I like that quite a bit. So we'll see. Got almost 1,300 people watching the stream between Twitter and YouTube. Thank you very much for being here. If you're enjoying what you're seeing, we are here Monday through Friday. Make sure to subscribe to the channel if you're new. Make sure to hit the thumbs up button on the stream if you've enjoyed this commentary. By the way, don't do thumbs up for me. Do it for yourself. If you thumbs up the stream, it will tell YouTube that the content that you're watching right now is something you'd like to see more. If you're watching on Twitter and you heart this, it will tell the x.com or the Twitter algorithm to show you more content like this. So do it for yourself and to support the stream. I appreciate it very much, and I'm thankful for everybody who's here today. We've covered a lot of markets today. I will just recap what I just said about earlier about gold. We're watching to see how the candle closes today. If it closes like this is a very bearish print for gold and could signal some more short-term downside on gold. But the opposite is also true. If you get a closure above this today, again, a good Fed catalyst could actually send this higher for the next few days or even weeks. Actionable setups for me right now, simplified. I'll just speed because it always, as a new trader, it would always drive me crazy when I would watch these streams and people wouldn't actually just tell you what their trades were. So I'm looking for a lot of trades, and I'll map them out really quickly. And I'm also in a couple of trades. I'll map them out really quick because I've got like 30 seconds. I'm looking for longs on NASDAQ if they give me a pullback. S&P and Dow Jones, same general area. I'm also long the euro at this current level. Would be willing to add to the trade if we do see some further decline. I'm also watching pound for possible trades. Don't have any positions there. I'm long CAD Swiss, and I'm long Kiwi Yen. I have a long position here. Willingness to add another position if we do get a push down here today, around 84.5. Okay, guys, I believe we have stream feed coming in. Let me just double check. He's not at the stand just yet, but we will have that on the screen here for you guys in just a second. Like I said, if you're enjoying the stream, subscribe, hit the thumbs up button. We'll bring up Powell in just a moment. Don't go anywhere. We'll be streaming that here, and I'll be reacting and sharing any key things that I find during the meeting. Okay, he's coming up, guys. Here we go.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Pardon me. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were likely driven by businesses bringing in imports ahead of potential tariffs. This unusual swing complicated GDP measurement last quarter. Private domestic final purchases, or PDFP, which excludes net exports, inventory investment, and government spending, grew at a solid 3% rate in the first quarter, the same as last year's pace. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a sharp decline in sentiment and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged 155,000 per month over the past 3 months. The unemployment rate at 4.2% remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Total PCE prices rose 2.3% over the 12 months ending in March. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up, as reflected in both market and survey-based measures. Survey respondents, including consumers, businesses, and professional forecasters, point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of the balance sheet. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. The tariff increases announced so far have been significantly larger than anticipated. All of these policies are still evolving, however, and their effects on the economy remain highly uncertain. As economic conditions evolve, we'll continue to determine the appropriate stance of monetary policy based on the incoming data, the outlook, and the balance of risks. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we'll balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we're well positioned to wait for greater clarity before considering any adjustments to our policy stance. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on inflation dynamics and the implications for our monetary policy strategy. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference next week. Throughout this process, we're open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking my question. A lot has happened since the last meeting. There's been tariffs put on, tariffs taken off, and meanwhile, there's a bill advancing in Congress. And I just wonder if I could press you on the last part of your statement. Are you any closer now to deciding which side of the mandate is going to need urgent care first?
Well, so as we noted in our statement, post-meeting statement, we've judged that the risks to higher employment and higher inflation have both risen. And this, by the way, of course, is compared to March. So that's what we can say. I don't think we can say, which way this will shake out. I think there's a great deal of uncertainty about, for example, where tariff policies are going to settle out. And also when they do settle out, what will be the implications for the economy, for growth, and for employment. I think it's too early to know that. So, I mean, ultimately, we think our policy rate is in a good place to stay as we await further clarity on tariffs and ultimately their implications for the economy.
Hearing you describe what you're looking for in terms of being able to make a decision, it sounded like that's a long-term process before you sound like you're going to be comfortable, or the committee would be comfortable to act on what the data is telling you.
I don't think we know. I think if you look at where we are today, we have an economy that, if you look through, the sort of distortions in Q1 GDP, you've still got an economy that looks like it's growing at a solid pace. The labor market appears to be solid. Inflation is running just a bit above 2%. So it's an economy that's been resilient and is in good shape. And our policy is sort of modestly or moderately restrictive. It's 100 basis points less restrictive than it was last fall. And so we think that leaves us in a good place to wait and see. We don't think we need to be in a hurry. We think we can be patient. We're going to be watching the data. The data may move quickly or slowly, but we do think we're in a good position where we are to let things evolve and become clearer in terms of what should be the monetary policy response.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's naturally a lot of PTSD around 2021 and supply shocks, but there are some who argue that the current situation has notable differences. Energy costs are down, housing imbalances look nothing like they did 4 years ago, labor demand appears to be gradually cooling with wage growth running below 4%. What do you see right now that could nourish higher inflation beyond a rise in goods prices this year?
I think the underlying inflation picture is good. It's what you see, which is inflation now running a bit above 2%. And we've had basically decent readings in housing services and non-housing services, which is a big part of it. So that part, I think, is moving along well. But there's just so much that we don't know. I think, and we're in a good position to wait and see is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low, we think. So that's what we're doing. And we'll see. The administration is entering into negotiations with many countries over tariffs. We'll know more with each week and month that goes by where tariffs are going to land, and we'll know what the effects will be when we start to see those things. So we think we'll be learning. I can't tell you how long it will take, but for now, it does seem like it's a fairly clear decision for us to wait and see and watch.
So when you say that you don't need to be in a hurry, does that mean that could the outlook change in such a way that a change in your stance could be warranted as soon as your next meeting?
As I said, we are comfortable with our policy stance. We think we're in the right place to wait and see how things evolve. We don't feel like we need to be in a hurry. We feel like it's appropriate to be patient. And when things develop, of course, we have a record of we can move quickly when that's appropriate. But we think right now the appropriate thing to do is to wait and see how things evolve. There's so much uncertainty. If you talk to businesses or market participants or forecasters, everyone is just waiting to see how developments play out, and then we'll be able to make a better assessment of what the appropriate path for monetary policy is. So we're not in that place, and as that develops, and I can't really give you a time frame on that.
Janelle Marte with Bloomberg. So many economists have been pricing in higher odds of a recession, and several are noting that it is more difficult for the Fed to cut rates preemptively given the higher risks for higher inflation. So given the outlook, do you still see a path for a soft landing, and what does that look like?
Well, let me say, so let's look back and see where we are. So to go through 2024 up to the day, we've had unemployment in the low 4s for more than a year. We've had inflation coming down now in the mid to low 2s. We've had an economy growing at 2.5%. So that is the economy as we see it now. What looks likely, given the scope and scale of the tariffs, is that we will see certainly the risks to higher inflation, higher unemployment have increased. And if that's what we do see, if the tariffs are ultimately put in place at those levels, which we don't know, then we won't see further progress toward our goals. But we might see a delay in that. I think in our thinking, we would never do anything but keep achieving those goals. But we would, at least for the next, let's say, year, we would not be making progress toward those goals. Again, if that's the way the tariffs shake out. The thing is, we don't know that. There's so much uncertainty about the scale, scope, timing, and persistence of the tariffs. So that's that. In terms of preemption, I think you can look back at the 2019 cuts as preemptive. I wouldn't say that what we did last fall was at all preemptive. If anything, it was a little late. But 2019, we did cut 3 times. But the situation was you had a weakening economy and you had inflation at 1.6%. So that's a situation where you can move preemptively. Now we have inflation running above target. It has been above target for 4 years. It's not so far above target now. And we have an expectation, conditional on what happens, that we'll see upward pressure on inflation. If you look at where forecasters are, they're all forecasting an increase in inflation. So it makes it, and then we've also got forecasts of weakening in the economy, and some have recession forecasts. We don't publish a forecast about that. We don't publish a forecast that assesses how likely a recession is. But in any case, it's not a situation where we can be preemptive because we actually don't know what the right response to the data will be until we see more data.
Colby Smith with the New York Times. How much weakness does the committee need to see, though, in the labor market and the economy more broadly to lower interest rates again? Is it about a certain increase in the unemployment rate over a period of time, or perhaps a certain number of negative monthly job reports? I mean, how are you making that assessment?
So first of all, we don't see that yet, right? We have 4.2% unemployment, good participation, wages behaving very well. Participation, I mentioned, at a good level. So, with the labor market, we would look at the totality of the data. We'd look at the level of the unemployment rate. We'd look at the speed with which it's changing. We would look at the whole huge array of labor market data to get a sense of whether conditions are really deteriorating or not. And at the same time, we'd be looking at the other side of the mandate. We could be in a position of having to balance those two things, which is, of course, a difficult balancing judgment that we'd have to make.
On that point about balancing, I mean, you've mentioned that the committee would consider how far the economy is from each goal and the time it would take to kind of get back to that point. But what does that mean in practice? I mean, how much of that assessment will be rooted in a forecast versus data dependence?
It would be a combination of the two. I mean, let's just say this would be a complicated and challenging judgment that we would have to make. Yeah, we're not in this situation, but the situation is if the two goals are in tension. So let's say that unemployment is moving up in an uncomfortable way, and so is inflation. Not the situation we're in, hypothetically, but we would look at how far they are from the goals, how far they're expected to be from the goals, what's the expected time to get back to their goals. We'd look at all those things and make a difficult judgment, and that's in our framework. It's always been in our thinking. We haven't faced that question in a very long time. So again, difficult judgment to make, and not one that we face today. And we may never face it, but we have to be keeping it in our thinking now.
Edward.
Thank you. Edward Lawrence with Fox Business. So we had the CPI report that came out that showed month over month the first decrease in inflation in about 3 years. The jobs report, you said, solid, that we saw. At the same time, we have those new tariffs that we're living under. So given this, should the Federal Reserve be cutting rates at all this year?
It's going to depend. I think you have to just take a step back and realize this is why we are where we are. Is we're going to need to see how this evolves. There are cases in which it would be appropriate for us to cut rates this year. There are cases in which it wouldn't, and we just don't know until we know more about how this is going to settle out and what the economic implications are for employment, for inflation. I couldn't confidently say that I know what the appropriate path will be.
So following on that, so then how does President Trump calling on you personally, as well as the Federal Reserve, to make rate cuts affect your decision today and affect your job difficulty?
Doesn't affect our doing our job at all. So we're always going to do the same thing, which is we're going to use our tools to foster maximum employment and price stability for the benefit of the American people. We're always going to consider only the economic data, the outlook, the balance of risks. And that's it. That's all we're going to consider. So it really doesn't affect either our job or the way we do it.
Howard.
Hi, Howard Schneider with Reuters, and thanks for the time. I'm wondering, I mean, given the complexity about the first quarter GDP and what lies ahead, I'm just wondering what your intuition tells you about the underlying direction of the economy right now. Many of your colleagues have said they feel growth is slowing. If so, do you have any sense of by how much, to what degree the slowdown may be? What does your gut tell you about how things are evolving out there?
My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy.
Well, let me press you on this idea of the economy being fine right now, because reading the Beige Book very closely the last time around, there was a lot of negative stuff, negative sentiment that was in there. And I know that everybody's looking at soft data right now. You mentioned it yourself that the sentiment's sour. But the Beige Book was talking about, the beginnings of layoffs in some industries, prices rising in some places, and an awful lot of investment decisions being pushed to the sideline. Doesn't that point to a slowdown?
It may well. It just hasn't shown up yet. And we all look at all these sentiment and read many individual comments just to get a better feel. And businesses and households very broadly are concerned and postponing economic decisions of various kinds. And yes, if that continues and nothing happens to sort of alleviate those concerns, then you would expect that to begin to show up in economic data. It wouldn't maybe show up overnight, but it would show up over weeks and months. And that may be what happens, but it hadn't happened yet. And also there are things that can happen that will change that narrative. I mean, they haven't happened, but it's possible to imagine things but in the meantime, yes, we're watching it extremely carefully like everyone is, but don't see really much evidence of it in the actual economic data yet. And by the way, consumers keep spending, credit card spending. It's still a healthy economy, albeit one that is shrouded in some very downbeat sentiment on the part of people and businesses.
That was a pretty hawkish response.
Michael McKee from Bloomberg Radio and Television. The Fed's been criticized recently by a former governor for what he calls mission creep. You take on more problems, use more tools, and then end up building tools to deal with the fallout of those tools, which then makes it a given that you will act more aggressively in the future. Is that a fair critique, and is that something you would be looking at in your framework review?
Sorry, say the critique again.
That the Fed has been involved in mission creep, gets involved in using too many new tools to deal with problems and to go too far. Is that something that the critique was based around the fact that you did QE and QE and QE and went beyond the narrow confines of your mandate?
So, well, I mean, there are a couple. That's not really beyond the confines of our mandate. I would say this: we did things. Essentially, we're on an emergency footing for a couple of years in the pandemic, and it's very fair and very welcome for people to look back over what we did and say, hey, you could have done this better and different. And one thing we hear a lot is we could have explained QE a little better. We did think we were explaining it in real time. I completely accept the thought that we could have explained it better. There's a lot of thinking that we went on too long with QE. I can tell you that the reason we did was we were concerned that we didn't want a sharp tightening in financial conditions at a time when we thought the economy was still vulnerable. And so we did hold on for a long time to QE, and we of course tapered and everything. And then we immediately went into QT, and we're down a couple of trillion. But I get we certainly, with the benefit of hindsight, could have tapered earlier or faster. That's absolutely right. But this is all very welcome. We knew doing this in real time that we weren't going to get it perfect, and those kind of after action kind of looks are essential, and we're doing the same thing in our review. So on some issues.
The other part of that critique is that you've taken on topics that are outside of the mandate, such as climate change and trying to ensure that certain groups are benefited by your economic policies in terms of employment, et cetera.
So, okay, on climate, you've heard me say over and over again that we will not be climate policymakers, and that our role on climate is a very, very narrow one. And I think that's what we've done. We've done really very little on climate. You can say that that little bit that we've done was too much, but I wouldn't want to give any impression that we've taken climate and it's something that we're spending a lot of time and energy on. We're not. We have very, very narrow things. We did one guidance for the banks, and then we did a one-time stress analysis, climate stress analysis, and that's it. And we dropped out of the network for greening the financial system. So we didn't do much on climate, but I do think, and I've said this publicly several times, I think it's a real danger for us to try to take on a mandate like that, which is very narrow application to our work. And the risk is if you go for things that are really not in your mandate, then why are you independent? And I think that's a very fair question. I do think we've done a whole lot less on climate than some people seem to think we did. Anyway, that's what I think.
Should you have taken on the question of bringing unemployment rates down for specific categories?
We didn't do that. What we said was that we never targeted any unemployment rate for individual racial or demographic groups. What we said was that maximum employment was a broad and inclusive goal. And I think what we meant by that was we're going to consider the totality of the country as we look at our maximum employment goal. Of course, we were never going to target any individual group with that, but I think some people, wanted to hear it that way. But that's not at all what we meant. So that's just not a correct reading of our. But I can see how maybe people found that confusing, and we have to take that into consideration.
Jolene.
Hi, Chair Powell. Thanks for taking our questions today. I'm Jolene Kent with CBS News. You've said wait and see, and the economy is doing fine today, but the impact of tariffs are already showing up at the ports. Businesses big and small are telling us that they feel it, and most importantly, consumers say they feel it, that the challenges are here, and there's no waiting and seeing. For Main Street, what is the breaking point? What would have to happen to prompt a rate cut specifically?
Well, so we really don't see in the data yet big economic effects. We see sentiment, there are concerns that higher prices may be coming or things like that. So they're worried now about inflation. They're worried about the a shock from the tariffs, but they really haven't. That shock hasn't hit yet. Okay, so we're going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there'll be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do. So people are feeling stress and concern, but unemployment hasn't gone up. Job creation is fine. Wages are in good shape. People are not layoffs, or people are not getting laid off at high levels. Initial claims for unemployment are not increasing, in any kind of impressive way. So the economy itself is still, in solid shape.
Just a quick follow-up. President Trump now says he does not plan to remove you as chair. When you heard that, what did you think?
I don't have anything more for you on that. I've pretty much covered that issue. Thank you.
Chris.
Hi, thank you. Chris Rugaber, Associated Press. Well, I just wanted to follow up. Earlier, it sounded like you said it was unclear how the Fed, what kind of interest rate decisions you will make later this year. So does that, in March, there was guidance that 2 cuts might happen, 2 cuts were penciled in for this year. Is that now, that guidance from the last press conference, has that been overtaken by events at this point?
We don't do a summary of economic projections at every meeting, as you know. We do it every other meeting, and so this was the meeting when we didn't do it. We don't also kind of poll people, so I really wouldn't want to try to make a specific projection for where we are relative to that. We will, in 6 weeks, we had the June meeting, and you'll have another SEP. I'm not going to hazard a guess here today as to what it would be. Again, what I would say is that we think our policy rate is in a good place. We think it leaves us well positioned to respond in a timely way to potential developments. That's where we are. And that, depending on the way things play out, that could include rate cuts. It could include us holding where we are. We just are going to need to see, how things play out before we make those decisions.
Great. And just to follow up on that, I mean, when you address the issue of how the Fed would handle both rising unemployment and rising inflation, how are you thinking about the fact that addressing one could exacerbate the other? So a rate cut to reduce unemployment could worsen inflation and vice versa. How do you handle those challenges?
You just captured this is the issue with the 2 goals being in tension. It's a very challenging question. Now, there can be a case in which one goal is very far, one variable is very, very far from its goal, much farther than the other. And if so, you concentrate on that one. And frankly, that was the case. Well, it wasn't a case where they were really in tension, but if you go back to 2022, it was very clear that we needed to focus on inflation. The labor market was also super tight, so it wasn't really a trade-off. I think what our framework document says. It says we'll look at how far each variable is from its goal, and also we'll factor in the time it would take to get there. So, that's going to be potentially a very difficult judgment, but the data could break in a way that it's not. I just don't think we know that. The data could easily favor one or the other, and right now there's no need to make a choice, and no real basis for doing so.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, Congress is currently debating spending cuts alongside extending the tax cuts. And I know you've talked many times about how the path of the debt is unsustainable, but given that we're also talking right now about the economy slowing, potentially even recession, I was just wondering, is there a danger that spending cuts now could slow growth a lot more?
We don't give Congress fiscal advice. We take what they do as a given, and we put it in our models and in our assessment of the economy. So I wouldn't want to speculate on that. I mean, I think we do know that the debt is on an unsustainable level, on an unsustainable path, not at an unsustainable level, but an unsustainable path. And it's on Congress to figure out how to get us back on a sustainable path. And it's not up to us to give them advice.
Well, do you think that they should take macroeconomic conditions into account as they look at this?
I think they don't need my advice and our advice on how to do fiscal policy any more than we need their advice on monetary policy.
Andrew.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. In your Jackson Hole comments last year, you said you would not welcome further cooling in labor market conditions. The unemployment rate then was 4.2%, which is what it is now. Many forecasters now predict a higher jobless rate. How has your tolerance for weakening labor market conditions changed compared to a year ago?
So it was quite a different situation. What was happening last year is that over the space of 6, 8, 7 months, the unemployment rate went up by almost a full percentage point. And it was click, 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 click each month. And you know, everywhere people were talking about downside risks to the labor market. At the same time, payroll job numbers were getting softer and softer. So there was a really obvious concern about downside risk to the labor market. And so at Jackson Hole and then in September, you know, we wanted to address that forthrightly. We wanted to show that we were there for we'd been there for inflation for a couple of years, and we wanted to show also that we're there for the labor market. And it was important that we send that signal. Fortunately, since then, the labor market has really, and the unemployment rate have really been moving sideways at a level that is, you know, well in the range of mainstream estimates of maximum employment. So that concern has gotten a lot less. So, you know, you're at 4.2% unemployment. I think we were in a very different situation. Now we have a situation where, you know, the risks to higher inflation and higher unemployment have both gone up, as we noted in our statement, and we've got to monitor both of those. We actually have a potential situation where there may be a trade-off or tension between the two, potentially. We don't have it yet, and we may not have it, but that's what we have, and that's why I think it's a very different situation.
I mean, I guess I want to follow up by asking how much of a rise in the jobless rate you could tolerate.
I can't give you I'm not going to try to give you a specific number. I'll just say we have to now be looking at both variables and which of them is demanding. If one of them is demanding our focus more than the other, that would tell us what to do with policy. If they're more or less, equally distant and equally or not distant, then we don't have to make that assessment. The assessment is you wait. So I'm not going to try to be really specific about what we need to see in terms of a number. But if we did see significant deterioration in the labor market, of course that's one of our two variables, and we would look to be able to support that. You'd hope that it wasn't also coming at a time when inflation was getting very bad. And again, we're speculating here. We don't know this. We don't know any of these things. It's very hypothetical. We're just going to have to wait and see how it plays out.
Thanks.
Hey.
Claire Jones, Financial Times. In terms of getting some clarity, we've got some talks at the weekend in Geneva between the US and China. A lot of economists are attaching an awful lot of importance to what we hear from those talks. How much importance are you attaching to them in terms of judging what will happen to the US economy going forward? And just in a similar vein, some economists are saying it's days, not weeks, that we have until we start to put the US economy at risk of seeing the sort of pandemic era shortages and higher prices if we don't kind of soothe relations between the US and China. So it'd be good to have your view on that too.
So, these are not talks that we're in any way involved in, so I really can't comment directly on them. So, but what I will say is this, we had, coming out of the March meeting, the public generally had an assessment of where tariffs were going, and then April 2 happened, and it was really substantially larger than anticipated in the forecasts that I had seen and in our forecasts. So, and now we have we're in a new phase where it seems to be we're entering a new phase where the administration is beginning talks with a number of our important trading partners, and that has the potential to change the picture materially or not. And so I think it's going to be very important how that shakes out. But we simply have to wait and see how it works out. It certainly could change the picture, and we're mindful of not trying to make conclusive judgments about what will happen at a time when the facts are changing.
And just on the fall in shipping volumes from China over these tensions, I mean, do you share that concern that we could start seeing goods shortages and higher prices in the coming weeks if this isn't resolved very quickly? I don't want to get we shouldn't be involved even verbally in the questions about the timing of these things. Yes, of course we follow all that data. We see the shipping data, we see all that, but ultimately this is for the administration to do. This is
this is their mandate, not ours. And I know they're, as you can see, they're again beginning to have talks with many nations, and that has the potential to change the picture materially. So we'll just have to wait and see.
Kosuke Takami with Nikkei. Thank you for doing this. The volume of imported goods increased significantly in the first quarter. Do you think that this situation could cause a delay in the impact of tariff on inflation? And does this mean that it will take longer time to reduce uncertainty?
The decision we made today? Which decision?
So the future decisions. So the volume of the imports, imported goods increased significantly. So the impact on the imported inflation may delay. So what is the impact to your future decision?
Okay, so I mean, I think we think that there was a big spike in imports, right? Very big, historically large, really, and to beat tariffs. And now that should actually reverse, so that it's the difference between it's exports minus imports. So and imports were huge, and so that it conveyed a very negative contribution to U.S. GDP, annualized GDP in the first quarter, as we all know. So that could, in the second quarter, be reversed, so that we have an unusually large contribution to usually positive. That's very likely as imports drop sharply. You could also have, very likely you'll have restatements of the first quarter. It'll turn out that consumer spending was higher. It'll turn out that inventories were higher, and so you'll see those data revised up. It may actually go into the third quarter too, and so I think this whole process is going to a little bit make it harder to make a clean assessment of U.S. demand. I mentioned private domestic final purchases, which doesn't have inventories government or inventories government. Anyway, it's a cleaner read on private demand, but that too probably was flattered a little bit by by strong demand for imports to beat tariffs. So that might overstate. It's a really good reading, 3% PDFP in the first quarter. That might actually overstate. So it's not really going to, I don't think it's going to affect our decisions. I will just say, though, that it's a little confusing, and it's probably less confusing to us than it would be to the general public as we try to explain this. It's complicated, and GDP is sending a signal, PDFP is sending a signal. It's a little bit confusing, but I think we understand what's going on. It's not really going to change things for us.
Courtney Brown from Axios. I guess, we talked about some of the indications of potential layoffs, price hikes, an economic slowdown, all being evident in the soft data. I'm curious why the Fed needs to wait for that to translate into hard data to, make any type of monetary policy decision, especially if the hard data is not as timely or might be warped by tariff-related effects. Are you worried that the soft data might be some sort of false warning?
No, I mean, look at the state of the economies. The labor market is solid, inflation is low. We can afford to be patient as things unfold. There's no real cost to our waiting at this point. Also, the sense of it is we're not sure what the right thing will be. There should be some increase in inflation. There should be some increase in unemployment. Those call for different responses. And so until we know, potentially call for different responses. And so, until we know more, we have the ability to wait and see. And it seems to be a pretty clear decision. Everyone on the committee supported waiting. And so that's why we're waiting.
Just a very quick follow-up. There was this sort of vibe session, if you will, where the sentiments expressed in soft data did not translate into the hard economic data. How are you thinking about that when interpreting some of the signs in the softer survey data?
I think going back a number of years, the link between sentiment data and consumer spending has been weak. It's not been a strong link at all. On the other hand, we haven't had a move of this, speed and size. So it wouldn't be the case that we're looking at this and just completely dismissing it. But it's another reason to wait and see. You're right that we had a couple of years during the pandemic where people were saying just very downbeat surveys and going out and spending money. So that can happen, and that may happen to some degree here. We just don't know. This is an outsized change in sentiment, though, and so none of us is looking at this and saying that we're sure one way or the other. We're not.
Matt.
Thanks, Chair Powell. Matt Egan with CNN. So you mentioned earlier that you're monitoring the shipping data, and we have seen in the shipping data that imports from China into the Port of Los Angeles have plunged, and that has raised concerns about potential shortages. What tools, if any, does the Fed have to ensure that prices and inflation expectations don't get out of hand if tariffs do cause significant supply chain disruptions?
I mean, we don't have, the kind of tools that are good at dealing with supply chain problems. We don't have that at all. That's a job for the administration and for the private sector more than anything. What we can do with our interest rate tool is we can be more or less supportive of demand, and that'd be a very inefficient way to try to fix supply chain problems. But we don't see the inflation yet. We're of course reading the same stories and watching the same data as everybody else, and right now we see inflation kind of moving sideways at a fairly low level.
If I could follow up on that, President Trump has indicated that he will likely name a replacement for you when your term as chair expires next year. But your position on the board runs through January 2028, I believe. Would you consider remaining on the Fed board even if you're no longer chair?
So I don't have anything for you on that. My whole focus is on, and my colleagues' focus is all on, trying to navigate this tricky passage we're in right now, trying to make the right decisions. We want to make the best decisions for the people that we serve. That's what we think about day and night. And this is a challenging situation, and that's 100% of our focus right now.
Let's go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Public records of your schedule so far this year show no meetings with President Trump. Past presidents Obama, Bush, and Clinton have all met with Fed chairs, and you met with Trump during his first term. Why haven't you asked for a meeting yet with the president?
I've never asked for a meeting with any president, and I never will. It's not, I wouldn't do that. There's never a reason for me to ask for a meeting. It's always been the other way.
So would you want to meet with him if given the opportunity to get more information?
It's never an initiative that I take. It's always an initiative. I don't think it's up to a Fed chair to seek a meeting with the president, although maybe some have done so. I've never done so, and I can't imagine myself doing that. I think it's always comes the other way. A president wants to meet with you, but that hasn't happened.
And if I could just ask one question on monetary policy, when it is time to cut rates, how will you determine how far down rates will have to come to try to keep a balance on the inflation mandate as employment weakens?
I think once you have a clear direction, you can make a judgment about how fast to move and that kind of thing. So it's really the harder question is the timing, I think, and when will that become clear? And fortunately, as I mentioned, we have our policy in a good place, the economy's in a good place, and it's really appropriate, we think, for us to be patient and wait for things to unfold as we get more clarity about what we should do. Thanks very much.
All right, guys, there we go. Quite the meeting. Not a very volatile in terms of price action meeting, but a lot was said, a lot of back and forth. Couple things that I thought were interesting. I would say that he leaned a little bit more on the hawkish side. right there towards the end, he pointed out that a lot of the concerns around the tariff stuff is that it is supply side, and talking about the imports and shipping stuff going on right now. Anything that kind of hurts the supply side is inflation that he mentioned that the Fed doesn't quite have the tools to handle with their interest rate policy. Some interesting points across the board there. I would say that, like I said, he leaned a little bit more hawkish than what I thought he would. Well, actually, I don't know. I kind of take that back. I did sort of discuss this concept that he would point at where the state of the labor market is and where inflation is, and where it currently is not in a disaster in either direction. He also went at length talking about he's going to keep an eye on which policy or which problem becomes the bigger problem, right? So if he discussed the possibility in their statement today that there could be increased problems on inflation and rising unemployment rate. Both of those are possible risks to the system right now. And he discusses specifically that the way they would handle that if pressed into that situation, which he said, we're not in that situation now, but if we were in that situation, he said, we're going to look for which one is further from the mandate and focus on that one. He highlighted that in 2022, inflation was running off the, running like crazy. That became their focus, right? They really focused on their decision-making based around inflation. Right now, still some equal risk seem to kind of be the stance, which I would take as kind of a hawkish stance, considering some people are like, hey, the soft data, you saw that girl ask about the question about the soft data, right? That woman mentioned that the soft data pointing out that sentiment looks really rough out there, and that why isn't the Fed acting on that? Powell responded in a hawkish way, saying that basically, those data points can be misleading. People can say things look really bad out there and then go buy a brand new car. He's used that expression before. So he pointed towards a lot of opportunities he had where he could have said, reasons for rate cuts might be around the corner. He really declined that opportunity. I wrote down notes here. Hawkish to neutral, tariffs could offset the Fed's goals. No need to move rates yet. Market thinks Fed will cut 3 times, but Powell pointed out that they only cut 3 times in 2018, when back then inflation wasn't a big problem. So if he thinks that 3 times in 2018 without an inflation problem, it kind of points towards a hawkish stance, suggesting that he's thinking less than 3 this time around, because we do have an inflation problem this time around with Trump tariffs being imposed. So to me, it came across pretty hawkish. We see that in the dollar index. Take a look at the 1-minute chart here of the dollar index. You can see we've had some push higher. NASDAQ and S&P 500 were in both directions. Really not a whole lot of movement on that front. Gold took a downside plunge off of that, which makes sense. A little bit of a pushback on rate cuts, but possibly what is a give and take for the stock market is that Powell seems pretty strong on the U.S. economy at this time, which is a good signal, right? Pointing out that people are employed, that prices have come, the price stability has improved, but they still got work to do. So it's not mission critical, which is good for stocks that we're in that kind of, we're okay. We're not crashing or falling apart, but also very strong for the dollar, suggesting that, again, inflation risks remain elevated. Fed may not be cutting rates too quickly. He definitely came across pretty hawkish in my view. I don't know what you guys think. Let me know in the chat. I'm going to wrap it up there. We've been streaming for 5 hours here between everybody who came on to contribute to the A1 Trading Show. I very much appreciate it. Remember, guys, last call on the EdgeFinder sale. It is currently 45% off to get access to our VIP Signals group or the EdgeFinder, the software tools that we use to analyze the markets each and every day on my streams and videos. Take advantage of the 45% off by clicking the link right here, sending us a direct message, letting us know that you're watching the stream and you'd like to hear more about the 45% off discount. Okay, guys, that's it. Thank you very much for tuning in. I hope that was helpful to you. Have a great rest of your day, and we'll see you back tomorrow.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. All month long, you can get the EdgeFinder 40% off, our best discount of the year. Check out the links in the description below to visit the EdgeFinder homepage or speak with a team member directly to get the 40% off discount now. Trade safely, and we'll see you tomorrow.